And so we're now live streaming. All right, then. Good morning. So we'll go ahead and call the meeting to order. Let's go ahead and take the roll call. This is the Standing House Committee meeting for the Minerals Business and Economic Development. What we're going to take up today are House Bill 8, House Bill 6, House Bill 9, House Bill 10, and House Bill 11. These are 5 bills that were worked by the Joint Minerals Committee through the interim. They have been assigned to the House, read in, assigned to our committee for the first step in the process. So let's go ahead and we'll get rolling. And if we could take a roll call attendance here for committee, please.
Thank you, Mr. Chairman. Representative Baer.
Present.
Representative Burkhart.
Here.
Representative Duncan.
Here.
Representative Ayer.
Here.
Representative Gray.
Here.
Representative Heiner.
Here.
Representative Sherwood.
Here.
Representative Western.
Here.
Chairman Greer.
Here.
You have a
Okay.
quorum.
Thank you. Good morning, everyone. Just a couple things we'll go over. One is that, to be present at the meeting, we have to have video. To take a vote, we have to have your video. If we have a problem with video, I'll be flexible. We'll figure that out. Okay, we're working with technology across the state of Wyoming, and well, for the most part, it's pretty good. It's still got some ups and downs in it. A couple things. I think we have some new members to the legislature, and a new member to the committee, and a returning member to the committee. We find that if we take things in a more formal process, that it works very well. And so again, this asks good, intelligent questions. This challenge the issues the best we can, but this worked through the chair. So for example, Commissioner Faulkner is going to be speaking on probably both of the first bills up. You'd say, Mr. Chairman, I'd recognize you. You'd say, Commissioner Faulkner. He'd go, Mr. Chairman, and then he'd say, Representative Baer, and then answer your question. We'll go slow, respectful, and we can do some very good work that way. And may seem a little heavy-handed, but I've just found that it is just the most efficient way to move forward. So with that too, the function of raising your hand is okay, but go ahead and feel free to put your hand up. When we're voting on amendments, that's the same thing. We put our hand up in front of our face. I'll count those. I'll do, and I'll say, whatever it is, 8 in favor, 1 opposed. When we do decide to take a bill and recommend it, go to committee of the whole or move forward, that'll be a roll call vote for us. So everybody good to go? Any questions? All right. Representative Western, you ready to go? We're going to work you in this committee, my friend.
Let's do it, Mr. Chairman.
All right. So with that, well, we have up a bill that has got a lot to it, a lot of pages anyway. It was assigned to a subcommittee that met separately with some of the stakeholders. Vice Chair Duncan had led that subcommittee for us and worked this bill through when we passed it through in the interim. And so I'm going to go ahead and let Representative Duncan give us an overview of it. And kind of walk us through the bill, and then we'll probably from there move to the Banking Commission to for questions along that line. But if you have a question as we go ahead and ask. And we'll just interrupt Representative Duncan and try to catch those questions as we go. So with that, Representative Duncan, you want to walk us through House Bill 8?
Thank you, Mr. Chairman. On a high level, this is a modernization and a cleanup bill. The biggest change that is being proposed is to combine 2 separate and confusing methods for licensing and registering a creditor to authorize them to extend consumer credit in Wyoming into one section that clearly outlines the requirements. The bill is also clarifying that the licensed lender can also engage in sales finance company activities without the need to apply for and pay the expenses of carrying a second license. So walking through the bill, turn to page 2, if you will, on line 6. The new section 40-14-454 pertains to the refunding of unearned charges for credit-related ancillary products. And ancillary products are things like credit, life insurance, disability insurance, gap waivers. And if coverage terminates prior to the term for which it was written, it requires a creditor at a time of termination to make or facilitate any refund to the customers within 60 days of the termination. Over on page 3, line 4, 40-14-454, section B, it requires that unless otherwise provided by law or established by rule of the commissioner, any necessary refund of the credit-related ancillary products upon termination shall be made on the pro rata basis. Insurance statutes already require credit-related insurance products to be refunded on the pro rata method. On page 4, line 13, we're deleting a comma and inserting the word and on 14 through 15, we're deleting consumer-related loans and consumer-related sales from the law, as these sections are not necessary and are confusing and cause regulatory inefficiencies. Over on to page 5. On page 5, lines 2 through 4 is deleted to make it consistent in all of our laws, citation for the Depository Institute. And then on line 4, we're inserting the words in Depository Institution. Down on lines 7 through 8, insert language is to clarify the late payment charges for the current installment is the period between regular scheduled payments. Down on lines 10 through 16, the Wyoming Uniform Consumer Credit Code, the UCCC, applies to creditors who are regularly engaged in extending credit. This definition is to clarify how that term is currently enforced and matches the standard under the federal regulation Z, the Truth in Lending. Lines 8 through 19 are just conforming language. Over on page 6, lines 1 through 18 is a technical change to include new definitions in the definition index. Line 20 is deleting the reference to the consumer-related sales as section 40-14-253 through to 60 are being replaced. On the next page, page 7, lines 1 through 3 is clarifying language to the current requirement that that persons making consumer credit sales or leases need to be registered with the Division of Banking. Lines 13 through 14 is to delete the inefficient language that doesn't come into play and limits the coverage of the Wyoming UCC to consumer sales of $75,000 and under, $75,000 and under. Line 19 and continuing on over to page 8, line 9, is to increase the minimum finance charge amount for revolving charge accounts from 50 cents to $3. The 50 cents amount was established in 1968, and it's being adjusted to reflect inflation over time. This same change is also made on page 14, lines 11 through 18 for revolving loan accounts. Further down on lines 17 through 22 on this page is clarifying language. It's the Military Lending Act, MLA enforcement is already contained in Article 3 loans of the Wyoming UCCC and is being added to Article 2 sales as recent changes to the MLA could make the requirements to apply to some sales transactions. Over on to page 9, lines 4 through 5 is clarifying language to delete the reference to 40-14-523 as that provision was repealed in 2013. Lines 11 through 19 is clarifying language to specifically state in the statute that payment servicers are not required to be licensed as a sales finance company, and that a company holding a lending license under Section 302 can also engage in sales financing without having to obtain a second license. Starting on line 21 and continuing over to page 10 on line 6, this clarifies that the Depository Institute and lenders licensed under the 302 can engage in sales financing without obtaining a sales finance company license. On page 10, lines 11 through 12, it's deleting the reference to consumer-related loans again. 40-14-355 through 358 are being repealed. Lines 14 through 19 is a change in the confusing and inefficient distinction between consumer loans and supervised loans and make all lending covered under one section requiring a license for all consumer lenders. Moving on to page 11, line 5 through 20, and then on over page 12, line 5, is to clarify the first lien mortgage loans to acquire ownership of the property are not covered under the Wyoming UCCC. They are covered under the Wyoming Residential Mortgage Practice Act. Lines 15 through 18 on this page is to delete the inefficient language again that doesn't come into play and limits the coverage of the Wyoming UCCC to consumer loans of $75,000 and under. On page 12, line 7 through page 20, line 12. All of these changes are necessary to clarify the confusing and inefficient distinction between consumer loans and supervised loans, and to consolidate all lending activities into one section requiring a license for all consumer lenders. Now, if you'll jump clear over to page 20, on lines 20 through 23, it's clarification to the citation of the Military Lending Act. And on page 21, line 5, 10 through 14, is technical changes needed for the creation of the new section of 40-14454. From line 16 through page 26, line 3. These changes are necessary to clarify the confusing and inefficient distinction between consumer loans and supervised loans, and to consolidate all lending activities into one section requiring a license for consumer lenders. And over on page 26, line 12 through 10 through 12 is a technical change to address the repeal of section 257 and 355, consumer related sales and consumer related loans. On the next page, on 27, lines 2 through 3, is to exclude all depository institutions from the requirement to file the annual notification report and to pay the annual fee, as this requirement cannot be applied to federally chartered institutions, and annual banking supervisory fees paid by state chartered banks to the Division of Banking adequately accounts for administration of the Wyoming UCCC. Line 11 through 12 are technical changes, as the Office of Thrift Supervision no longer exists. And over on page 28, lines 11 through 12 is a technical change to reflect the new ending section of Wyoming UCCC. Thank you, Mr. Chairman, and this concludes my walking of the bill. I'll stand for any questions. However, the Division of Banking would be more apt to be able to answer your questions. I will have another amendment, as you guys all received the email that cleans up a part here.
Yeah, so, yeah, Representative Duncan, thank you for that walkthrough and good practice for the floor if we get there. Committee, do you have any questions for Representative Duncan at this time? We'll take some testimony and maybe focus in on a couple of more narrow issues in this as we progress. But any questions for Representative Duncan? So I am going to ask one, and again, Representative Duncan and then Representative Aaron Burkhardt. You know, we did have a discussion. If you'll notice on the consumer side, the limit was set at $75,000 for by the interim committee, and a long discussion about that. So just a point to think about as we move forward. And I just say that for the new members to think about. I'm not wed to it one way or the other. And then Representative Duncan, again, just maybe, can you speak just a little bit about the cleanup regarding, you know, making these consumer loans versus what were supervised loans, and that confusing language? That's a big component of this cleanup. Is that a fair statement?
Yeah, that's a fair statement. There was a lot of confusion by, not so much by the lending industry, but more so in like car dealerships and some of these other entities, and having to have multiple licenses. And so nothing's been changed since, I believe, the 70s. And so they went through and cleaned up all of this. And it was based on the complaints that the Division of Banking has received throughout, you know, history and time. And so this is a culmination of cleanup from that, the different complaints or the different issues that they've had. And that's where all of this stemmed from mainly.
Okay. All right. So with that, I'll ask a little new here at using this webinar feature, but I recognize in the attendees some of the names. Amanda, can they raise their hand so I know who wishes to testify on this, so I can sort of get my thoughts together on how to move forward?
Mr. Chairman, they should be able to raise their hand and we can move them in.
Marcia Allen has raised her hand. Dave has. Okay. Those are ones I would expect on this issue. Okay. All right. Very good. All right. So let's go ahead and go to the Banking Commission. And then Commissioner Fortner, if you would introduce yourself to the committee, and we'll let you have your comments and add anything you wish to.
Thank you, Mr. Chairman. Good morning, committee. Albert Fortner, Banking Commissioner here in the Division of Banking. I have with me our two deputy commissioners, Joe Mulberry, who oversees our non-depository, which this bill falls under, and then Jeremiah Bishop, who's deputy commissioner over our banking and trust side. So, Representative Duncan did a great job walking through that. It won't rehash anything, but I did want to highlight a couple things that some of the terminology you heard her use, efficiencies, cleanup, outdated, things like that. And when you think of government efficiency, obviously, how we use our financial resources is a big part of that. But also, I think having an efficient set of statutes for which the industry is subject to. And so this is one where we've been kind of putting together a number of issues that the kind of the common questions or things that didn't make sense anymore kind of culminated into this bill. And so that, one of the big things is combining those two license types into a single license, just covering consumer loans and all the other things that the representative went through. So that's a big chunk of it, Mr. Chairman. And the other thing I wanted to highlight, again, as the Division of Banking, we regulate all financial institutions and consumer lending activity in the state of Wyoming. And so I wanted to circle back to page 27, if I can, and explain lines 2 and 3, where it says that supervised financial institutions are exempt from this. And as Representative Duncan said, so nationally chartered banks and federally chartered credit unions have preemptive authority over the UCCC. And so for a big chunk of it anyway, but and so they don't pay the same supervisory fee or notification fee, as we call it, as a state charter bank does. So think of if an auto dealer sells its paper to financial institutions, and if they've got three institutions, one being a state chartered bank, one a national, and one a credit union, only the state chartered bank pays that supervisory fee, the other two don't, and therefore the dealership is responsible for paying that. And so, as I said, all the banks that we regulate pay semi-annual assessments based on their size, and their cost of supervision is covered in that. And also, we looked at it to be a parity issue that, the state charter banks in Wyoming shouldn't be disadvantaged to a national charter and have to pay an additional fee like this one, when again, the cost of supervision is already covered. So just wanted to highlight that was the thinking behind that. And we factored that into kind of our budgeting and again the assessments on the bank side. So with that, Mr. Chairman, I guess if there's any specific questions or anything else that you'd like myself or probably more appropriately Joe Mulberry to address, we sure can.
Yep. Committee, any questions? Commissioner Fortner? Okay, I do have one, and then Commissioner, you've seen the proposed amendment. Have you had an opportunity to see that? And that is to page 27 after line 3 regarding those fees. Have you had the opportunity to look at that?
Mr. Chairman, have not.
Okay, well, all right, we may circle back if you hold tight. Circle back if we work that, and I think that issue will be brought up and discussed a little bit further. Okay. Committee, any other questions? Okay. So I do have a question. Go ahead, Commissioner.
Oh, no, nothing here.
Yeah, I had a question for Joe Mulberry, and again, that was, I'm just trying to refresh my memory regarding that threshold of 75,000. And that, and I guess I'll ask the question this way: does that cover? Is that threshold high enough for the state of Wyoming?
Thank you, Mr. Chairman. I guess it just it depends on the wishes of the committee. Currently in the statute, the $75,000 threshold is what the current threshold is. What we're removing is that there's some additional language that says, or the transaction is secured, or the loan is secured by an interest in land. That doesn't come into play, and again, that's where we're trying to make some efficiencies, because we have to have a lot of regulatory discussions with folks about the applicability of the Uniform Consumer Credit Code, and we always have to explain that additional part. That again, we don't generally see loans that are secured by an interest in land that then fall under the Uniform Consumer Credit Code. So we're just removing that portion. We're leaving the $75,000. At this point, it's just a matter, because yeah, you're going to have some very high-end, here in Wyoming, you can have a high-end truck that somebody buys that's more than $75,000. If that's the case, then that transaction is not covered under the Uniform Consumer Credit Code. And so I do feel like at the $75,000 threshold, that we're probably capturing the majority of consumer credit transactions here in Wyoming, because the Uniform Consumer Credit Code, the body of law we're dealing with, is only non-mortgage related consumer credit transactions. If we're talking about consumer credit to buy your home, that's covered under a different body of law, the Wyoming Residential Mortgage Practices Act. So we're really talking about this act that's non-mortgage consumer lending, and I think that the $75,000 appears to capture at least the majority. Are there going to be some that do fall outside of the threshold? Probably, but you're probably going to get that whatever dollar amount you set it at.
Okay, thank you. Representative Western.
Thank you, Mr. Chairman. Mr. Mullery, so let's say if we're doing a commercial real estate transaction that's under $75,000, say a vacant lot that's zone commercial, where would that fall in all of this in terms of regulation? Thank you, Mr. Chairman.
Mr. Chairman, so that is not covered. So a commercial transaction, the applicability of the Wyoming Uniform Consumer Credit Code talks about that the proceeds of the transaction have to be used for the borrower's personal, family, or household use. And so if it's a consumer credit transaction, it falls under the code. If it's a commercial transaction, it doesn't. And so at that point, then there's not really a specific body of law that regulates commercial lending in this same manner as consumer lending. At that point, if it's a commercial transaction, you really fall more under just a general contract law.
All right, you good? Okay, any further questions? Yeah, Representative Heiner.
Thank you, Chairman. Mr. Mallory, the consumer loans that were secured by land was originally written into this law when it was originally codified. So why was that originally put in there, that dwellings and land could be included, but now we're taking that out? Thank you, Mr. Chairman.
Go ahead, Mr. Mulberry.
Mr. Chairman, I guess the why, I'm not real sure. Like I said, this bill was enacted by the written by the Uniform Law Commission back in 1968, and that was part of the original drafting of it. The why it was in there, I'm not real sure on the why. I just know that in the 28 years that I've worked here, that portion of it has never come into play. We've never cited a transaction that came under our jurisdiction solely because it was secured by an interest in land and it exceeded the dollar threshold. And we're currently again at the $75,000 threshold. So back to just real quick back on the original question about the threshold. Again, I've worked here for 28 years. When I first started, this body of law covered consumer credit transactions of up to $25,000. At some point in the past, we bumped it up to $50,000, and then it's been increased subsequent to the current level of $75,000. So there has been some movement in that over the years. I don't recall when the last jump was made, but it originally started at $25,000. And again, the provision that we're striking is just, it doesn't come into play other than the fact we have to have a lot of regulatory discussions about it when we're putting together our correspondence about the act and what pertains to it. We got to make sure and include that language and an explanation of how it comes into play. So it's more of just an efficiency kind of thing, so that we don't have to continue to have a regulatory discussion with folks about something that just doesn't come into play.
Okay, Representative Bear.
Thank you, Mr. Chairman. And this question is for Mr. Maloney. The $75,000, I know it was discussed in the interim, and that is basically one of the higher numbers throughout the nation. But it seems that since we have to keep changing this, it might be more efficient to go ahead and choose a higher number. And my question really is, those transactions that fall outside of this code, because they are higher, what happens as far as coverage of those transactions if there is a consumer issue? Thank you.
Go ahead, Mr. Mulberry.
Yeah, Mr. Chairman, thank you. If a transaction falls outside the threshold, then the law wouldn't apply and we wouldn't have any regulatory authority over it. For example, if somebody buys a pickup truck that costs $80,000, and then they feel like that they had an issue, that there was a problem on their credit transaction to purchase that vehicle, and they contacted our office, we would look at and try to apply that transaction to our law, but because it falls outside of the dollar threshold, we wouldn't be able to exercise any kind of regulatory authority over that transaction.
Okay. All right. Any further questions? Okay. With that, I think we'll move on. Go ahead, Representative Bear.
Thank you, Mr. Chairman. Mr. Mulberry, is there any drawback from increasing that number at this point, that threshold?
Mulberry, go ahead.
Mr. Chairman, I guess not to our office. I think you might get a different answer from the industry folks. They would have to, more transactions will be covered. I don't think that there's a lot of, creditors out there that aren't doing the same thing, following their same procedures on an $80,000 loan than they're doing on a $70,000 loan. But it would mean that more transactions fall under the code. And so when you get to items such as the notification filing section of the code, every year all creditors have to report the volume of consumer credit transactions that were made under the jurisdiction of the act. They report that volume to us and they pay the notification volume fee to our office that we use to administer the act. And so by increasing the dollar amount, then they would have to add those additional loans that do fall under the code now into their annual volume and probably pay a slightly higher annual fee to our office.
Okay. All right. Well, we'll keep moving. Yeah, good questions, committee. And all right. So I think let's go ahead. Let's make sure is there anybody else on the attendees list that wishes to testify? If they do, please raise your hand. And for right now, let's go ahead and I'll recognize Marcia Allen.
Good morning, Mr. Chairman.
Good morning.
Members of the committee, welcome to all of the new members. My name is Marcia Allen. I'm the Executive Vice President of the Wyoming Automobile Dealers Association, representing franchise new car and truck dealers in the state. As some of you know, a few of you know, and the new members, I did participate throughout the interim on this bill with the banking division, with the committee, Joint Minerals Committee, other interested parties, and also on the committee assigned working group. As a concern was triggered as a result of testimony provided during the last Minerals Committee meeting in November. After that meeting, I reached out to the banking division to discuss that concern and found that there are unintended consequences with language on page 27, lines 2 and 3. Specifically, this will shift the fee assessment liability from the state chartered bank to a non-lender creditor. Sorry, that one makes it really hard for me to say, which includes auto dealers. And that you heard how that worked in previous testimony from a previous speaker. And it's pursuant to language in Wyoming Statute 4014-632B. And just to follow up what you heard, basically what happens is persons who are required to file notification shall pay a fee of $25 for each $100,000 of consumer credit transactions made in the previous year and held for more than 30 days after inception, or they are sold to an assignee who has not filed notification. This exemption would put state chartered banks in that classification now, and that is where the unintended consequences are. After discussing with the banking division and further researching it, was my understanding that the intent of the changes of page 27 were to eliminate additional fee liability and reporting requirements from state chartered banks, but not to shift the liability to anyone else. And that was also noted. It looks like the fiscal note also seems to confirm that intent. If I'm wrong, please correct me. I'm not afraid to say that I am easily confused with this bill in particular. It's been very confusing. So we have requested an amendment to take out the unintended consequences, but I am not good with wordsmithing, so have sent that out to have that looked at prior to. I would just quickly answer a question as far as the $75,000 limit that has been asked. Our members, I've asked them, and most of them weren't even aware of that $75,000. They don't treat any transaction. If it's an $80,000 truck purchase, they're treating it the same as if it's a $30,000. They're not changing their processes or anything. So they are treating all of their transactions as if they fall under this. The other thing I would note is that there is some confusion amongst our members because the federal level is much lower than the 75,000. It's at, I'd have to look, I think it's 58,000 something. I don't have this exact number, but I know it's much less than what Wyoming's level is set at. But I would say that our members are treating all the transactions, whether they're 30,000 or 90,000, the same. And I would be happy to answer any questions.
Okay, committee, any questions? Okay, so Ms. Allen, I just want to flesh out the concern on page 27 just a little bit. So as I understood, and I'll be the first to admit as well as I may not have understood correctly, but as I understood with subsection B, we talk about federal chartered banks and credit unions are preempted from this provision. And so it's your concern that if we don't make an adjustment and a state chartered bank has a fee associated with that, that gets pushed down to the auto dealers? Is that the concern?
Mr. Chairman, yes, because right now, as you heard, that the federal chartered banks or the credit unions, the dealers are already responsible for paying that portion of the fee. So if the state chartered banks are currently paying that fee. So if you take it out just with this language that's there, it will shift that liability that's currently being paid by the state chartered banks to the dealers or the non-credit lenders. So it's not just the dealers.
So Ms. Allen, I just want to follow up. So is that, so in essence, you're saying it'd be a double charge. Is that right or not?
No, Mr. Chairman, because they are not, the dealer is not responsible for that fee right now because of the way the statute is currently. If this change happens and on the language changes that it will exempt state chartered banks from that reporting requirement, then it moves it to the dealer. So that the state chartered bank will be paying it like they currently are, the dealer will.
Okay, I'm going to represent, because I think we're going to be discussing this a little bit further. Representative Duncan, do you have any questions or comment, or to maybe help clarify that issue just a little bit?
No, Mr. Chairman, but I do have an amendment to address this.
Okay.
So I don't know when you want.
Well, I want to make sure I have this clouded in my mind, and it's not a comfortable feeling. Ms. Allen, why don't you hold tight and let me go to the commission and ask them if they could comment on this at this point. Might be a better efficient use of our time. So Commissioner Forkner or Mr. Mulberry, do you have a comment on that?
Yeah, but Mr. Chairman, and I'll let Joe maybe address it as well. But yeah, as Ms. Allen said, that right now the fee, somebody's responsible for paying the fee, right? So whether it's the original creditor, which would let's use the an auto dealer for that. So they sell a car and it's financed. If that paper's sold to a national bank or a credit union, which a lot of it is, then that fee is the dealership is responsible for paying that fee because of the preemptive nature of the federal charter. If that same transaction were sent to, if that paper was sent to a state charter bank, then and who's the final creditor on that, the state charter bank pays that fee. So yeah, she is correct that the dealership is responsible for covering that for state and or for national and credit unions, but not for state charter banks. So yeah, this would say, as original language, this would say that the original creditor, if the paper goes to any of the institutions, supervised institutions, then the banks themselves, the state charter banks, are now exempt as well. And like I said, our thinking is we already receive a fee, a supervisory fee, and so we wanted to make sure that that there's just was parity amongst all three charter types. But I understand what the concern, and if there's anything else that Joe wanted to share on.
So Commissioner, sorry committee, but I just so what I think you and Ms. Allen are trying to get to the same point, or the same place, which is where I assume the committee wants to be, and that is, so we're not going to double charge a fee and disadvantage our state banks. We don't want that to happen.
Well,
right?
it's not a double charge. It's just it depends on who the final creditor is, right? So the dealer originates the loan and sells it to a bank or a credit union, and then that volume, that total and aggregate consumer volume, is reported to our office, and depending upon if you fall under this or not, is who responsible for paying that. So like I said, and that's where it sounds like it's a double thing. So if you think about a car dealership, and if they do $2 million in sales volume, and every transaction is under that $75,000 limit, they would report that and pay a fee based on that. But if the dealership sells all of their paper, again, to whatever financial institution, that financial institution is the one who calculates that amount and pays that fee. Except for state or national banks and credit unions, that fee, because they're not subject to Wyoming law, those institutions don't pay the fee. That goes back to the dealership. The paper that's sold to the state charter banks, they pay the fee. So again, we're not necessarily, I'm not gonna die on a hill on this. Our perspective is, as a regulator of state chartered banks, to ensure that there's parity, and if there's a way to do that and to make sure it's equal on the banking side, that's really all I care about. But if there's solutions to this, I will say again, the bulk of transactions realistically do go to credit unions and nationally chartered banks, probably not to state chartered banks. So my guess is the dollar amount on either side, either instant party, it's not a significant shifting. At the end of the day, I don't have the, I don't know, we haven't totaled up last year's amounts yet. We're right in the middle of that process. So, again, this is really, it's up to the committee how you want to, if you want to leave the original language and strike this, we're fine with that. If the amendment that we're able to, Representative Duncan sent us a copy of that, we're able to take a look at that. That might be a solution, or leave it as is. That's, like I said, in this case, ultimately somebody has to pay, and of course I get it. No one wants to pay any more than they have to, right? And so it's just a matter of who's going to be responsible at the end of the day.
Yeah. Okay. All right. I think I've got it now, and I think Representative Duncan's amendment gets there. I'm going to go to Representative Bear and then Representative Duncan. Go ahead, Representative Bear.
I just want to summarize and make sure I understand this properly. I'm sorry, Chairman, thank you. And this question is for you, Commissioner Faulkner. So what I'm hearing is that if we kept the law the way it is, the dealerships would pay the fee for the national banks because the national charters are exempt, but the state banks would not pay based on the exemption that we have here. Therefore, the dealerships would pay. Now, if we were to exempt the dealerships and the banks at the state level, there would be no one paying the fee. Is that an accurate assessment of what's being said here?
Go ahead, Commissioner.
Mr. Chairman, Representative, correct, yeah. And so it's the fees are set to, as I think the committee member knows, that our agency is 100% other funds, so there are no general funds that come to the Division of Banking, and so we're funded by the fees, and this is one of them that's been in statute for years. So, but yeah, that is correct. That fee volume, if it goes to a national bank or a credit union, the fee responsibility stays with the auto dealership as of today, and the state bank would pay that fee as of today.
Okay, let me go Representative Duncan and then Representative Western.
Thank you, Mr. Chairman. So I guess my question is to Ms. Allen and Mr. Faulkner, both. You've seen the amendment. What is your preference, to strike the language or to use the amendment? Which seems more fair?
But we'll go let Ms. Allen comment and then go to Commissioner Faulkner.
Mr. Chairman, Representative Duncan, I haven't seen the amendment, so I can't speak on the amendment, but we aren't opposed to having parity with the state chartered banks and them being treated the same. Where our concern is that it shifts the liability, and it's something that we understood would not happen. If you remember, and the new members won't remember, but at the very beginning, on the onset of this conversation, there was a proposal to shift the fees completely. And we had some really big concerns with that because it would impact us significantly. The fees, we're not talking about $25 or $50. Some of the dealers are paying $5,000 upwards a year in fees. So that's where the concern is that we're taking additional liability on in fees with this language, but we definitely don't have a problem with the state chartered banks being treated the same as the federally and the credit unions. They should be. I guess it boils down to, should we have to take on additional liability that we weren't anticipating and didn't discuss?
Okay. Okay, so here, well, let Commissioner Faulkner answer. And then I got Western up and then Representative Ayer. And then can we admit Scott Meyer in, please? Thank you.
Mr. Chairman, actually, I'll let Joel Mulberry address
Sure.
an issue.
Go ahead.
Mr. Chairman, again, this is a very confusing issue, but just try to provide just a little clarity in this. The elements of the transactions that are done like at auto dealerships and then assigned to banks is kind of a small portion of the notification filing requirement. And like Marcia said, this is kind of an unintended consequence of our primary purpose for originally putting this section within within our bill. That notification filing section, not only does it pertain to providing a notification of the transactions that are taken by assignment from auto dealerships, but it also requires all of our banks to file on all of the direct lending that they do and pay the fee for that. And again, all of our state chartered banks are filing and they're paying their fee based upon all of the direct volume that they do, which is the vast majority of business that they do. But yet, national banks and credit unions that are engaged in consumer credit, they don't have to file that report and pay the fee. And so that's the element that we were trying to bring some parity to, because it does bring the state charter at kind of a disadvantage of our nationally chartered institutions. So with that, then, the unintended consequences that the discussion that Marcia and I continued to have after the last committee meeting was that by excluding all of the banks out of the notification requirement, it then does bring into this element that if transactions get assigned to these banks, then it does put the onus back on and the requirement back on the original creditor to pay the fee. We then looked back at, we're processing the notification fees from 2020, but while we were having this discussion about this, we did look at the reports that came in 2019. And out of all of our banks that reported to us in 2019, only 4 institutions said that they took assignment of transactions from auto dealerships. And one of them indicated on their form that they were getting out of that. So we were going to be down to just 3 institutions that were still engaged in that activity of taking by assignment transactions from auto dealerships, but they're all engaged in direct lending. And so again, that was the primary purpose. And this provision has been in our in the proposed bill since our first draft. That was the primary purpose. And again, it wasn't to shift the burden on these transactions to the auto dealerships, as Marcia said, that's just been kind of an unintended consequence. But in looking at it, then yes, that is a consequence that happens by doing this. But I just wanted to kind of clarify what overall that provision does, and that provision is not in there solely with respect to the auto transactions.
Okay, so as I understand the issue and review the proposed amendment by Representative Duncan, we're looking at maybe three state charter banks within a small book of business. We're kind of putting in a parity component with this proposed amendment. But the only real issue on that, somebody's squealing here. The only real issue with that then will be just the how do we sort that out and account for it. So I think we've got this covered in a possible solution for that. So, okay, we'll try to keep moving on. Representative Western had a question, then Representative Bear.
Thank you, Mr. Chairman. I guess my question was kind of piggybacking on Representative Bear's comment in regards to about the exemption. I guess my question to the Banking Commission is, how much does this fee generate? How much do you guys rely on this fee for internal revenue?
Go ahead, Commissioner Fortner. I understand that your fees should be based upon your cost of administration, but I'll let you answer that.
Mr. Chairman, Representative, are you talking specifically to this section fee, the kind of our notification fee, and then are you? And then I guess we could even get more granular, the assignment versus direct lending. Yeah, like I said, it's I know. I think. And I don't know if I have that breakout, but because there's 2 parts, like Joe said, there's 2 parts to the notification fee. There's if you walk into a bank or credit union and you get a personal loan directly from them, even if it's a car loan, and then you go buy the car, or if they get a, they buy the paper from the dealership. So both of those are fees. I don't know if I have that number. I can sure get it to you what our total notification fee volume is, unless you have that with you. I don't know if we have that.
I got a variety of numbers, but I think that just to kind of get to the broader, point of your question about how much do we rely on the fee, the fee under the Uniform Consumer Credit Code, that fee that's built into the code is for our administration of the Uniform Consumer Credit Code. That's how we collect our fees under that body of law that we use to fund the regulatory efforts that we do. And as Albert said, the reason that we were excluding out the banks is because the banks already pay a significant fee to our office every year in their annual supervisory fees, whereas this law also applies, not only does it apply to banks operating in this space, but it applies to non-chartered entities as well. And so non-chartered entities that operate in this space, that's how we assess fees to pay for the administration of the act, is by creditors filing the volume of credit that they do under the act and then paying the fee.
Okay, all right, Representative Ayer.
Thank you, Mr. Chairman. My question deals with the fiscal note. It shows a reduction in revenue to the division. If the effect of this provision on page 27 is to just shift the fee responsibility from the state chartered bank to the dealership, why is there any reduction in the total revenue to the division?
Mr. Chairman, Representative Ayer. So again, if you think about that, the transaction or the assignment is what we're talking about with the auto dealership, but that's actually a smaller portion. So the direct consumer lending that financial institutions do, chartered entities and licensed entities, i.e., think of a sales finance company or something like that, that it's not a bank or a credit union. So they pay on that fee. And so right now, that's what we're saying is we would recognize less revenue from the state chartered banks because they would no longer be paying their assessment and this fee. We would just rely on their assessment.
And again, I just, for the committee that's new, the banking commission does not generate income for the state of Wyoming. They're supposed to generate, their fees are supposed to cover their costs of administration. So a reduction out of their office means less that's paid by the banks and the institutions that they oversee. Okay, all right, let's keep moving. Ms. Allen, do you have anything further?
No,
Okay.
Mr. Chairman.
All right, then, Representative Gray.
Thank you, Mr. Chairman. Just want to make sure we button down on this amendment here. The way I interpret this amendment is that nobody's going to be paying the fee on page 27. So what is the revenue impact to the department? And am I interpreting that amendment correctly?
Representative Duncan, do you want to comment on that, or do you want to comment on that, Commissioner? My understanding is that the state banks will be paying it, and you'll have to credit back. It'll require a balancing. But Commissioner Fortner, can you comment to that?
Yeah, Mr. Chairman. So yeah, the way we read this amendment, it's reducing the fee revenue. So we would have a fiscal impact. Again, I'm not sure how significant it is. I think we could probably manage that, but I don't have, we'll know better here in a few weeks when we finish our 2020 numbers, but this basically says this type of fee isn't paid by anybody. And so it's reducing our overall fee income a little bit. But again, I don't know if it's at such a level that, we can't absorb it. Now, at some point when revenue goes down somewhere, it's got to be shifted to someone else at some point. I don't think we're there yet, but that's how I would read it, that we just aren't going to collect it on this type of transaction. Is that correct?
Yeah, that's the way that I read that. But Mr. Chairman, I'd have to do a little bit more looking into the impact that it would have, because I think that in just reading this, it appears that whereas right now what we're talking about is just a kind of a smaller portion of the fee that's being assigned to the 3 institutions, it's state chartered institutions that file and still were paying the fee on these auto transactions. But with this amendment, then it would also then remove the requirement for the original creditor to pay the fee for the transactions that are assigned over to all national banks and credit unions, which is a pretty significant portion of the volume. And so I do think that that would be a pretty significant portion of the fee that our office receives. And so I think we would need to look at that a little bit closer.
That's right. Yeah, that could have a significant impact.
Representative Duncan?
Thank you, Mr. Chairman. So are you telling me that it's better just to strike that new language on page 27, that would be a better solution?
Mr. Chairman, Representative, yeah, again, it's part of it, if we keep it the way it was, then yeah, the banks will continue to, the state charter banks will continue to pay a fee that the federally chartered banks don't. And this is not on, again, let's put the assignment aside, because that is a smaller portion of that, that portion of the fee. So state charter banks will continue to pay something above and beyond what a federally chartered institution does. So they are, in essence, paying a penalty for having a state charter. Is a very, on a per institution basis, is it significant? I don't know. We could break it down on a bank by bank on their direct lending. But again, that's, which, I don't want to make this circular, but that again is what got our thinking is look, there, we've got a fee, a supervisory fee, so we shouldn't have them paying something else just solely based on their charter type when they already pay an assessment.
Okay, Representative Bear, question?
Thank you, Mr. Chairman. This question is for Ms. Allen. It seems to me that the language as it sits now before Representative Duncan's amendment would put this unintended consequence of this onus onto the dealerships or other lenders or other transactions. But doesn't this simplify it for the dealership, since they're already filing this fee for the national banks that they do business with? So it would be the same process for all transactions with banks. And isn't that fee, I'm a simple man, like I said, I need to understand, I assume that this fee is passed on to the consumer. So whether that's passed on at the bank level for a state charter bank, or whether it's passed on by the dealership, which is already doing it on their national bank transactions, now they would be doing the exact same thing on their state charter transactions. So that seems like it would be a simplified thing. It'd make it easier for the finance departments at the banks, I mean at the dealerships. Can you please share with me what your thoughts are on that?
Yeah, Ms. Allen?
Mr. Chairman, Representative Bear, that isn't something that I've asked them. I would guess under that it would make it easier, but there's a lot of confusion with my membership that I found throughout this process, that a lot of them think that they fall under federal guidelines, not state guidelines. So it's been an education process as well. So I don't really know how to answer or what the answer to that is. Probably it would make it easier, but there is a lot of confusion on their side with this whole fee, because it's broken out into different processes on how the worksheet or calculation for it every year that they file. It's if it's sold within 30 days, not held longer than 30 days, they are able to adjust that amount off. And then it goes into if it's assigned to a non-chartered bank or a federally chartered bank or a credit union, then it's brought into the calculation. So I even get confused with it, honestly, but that's not a question that I've asked our membership.
Representative Sherwood?
Hi, Mr. Chairman. I'm getting a message from a constituent that they cannot find this meeting on YouTube. So I just wanted to verify that it is streaming.
Yes, it is. If you look up in the upper left-hand corner of your screen, you'll see recording live on YouTube. Okay. All right. This try to move on. Although, so Dave figured I'm not treating you poorly, but I think what I'm going to do is ask Mr. Meyer to comment because I suspect he's on. We'll have comments on this specific issue. So, Mr. Meyer.
Thank you, Mr. Chairman. Just a couple of points that I just wanted to, as I was listening to the testimony, I think that the banks, on behalf of the Wyoming Bankers Association, I think that they were under the same impression I think that the Commissioner's office was. It's interesting to see, I guess, the amendment. I have not seen the amendment, but I understand how those unintended consequences could pop up, and so it's better to deal with it right now. But I think as a point of clarification, and I think the Commissioner's office had said as much, but when you're looking at it from a state charter standpoint, we just really have very few state charter banks that do the indirect financing. And I know that a lot of them are getting out of it. It's just, they're not going to really compete very well with whether it's credit unions or whether it's like, for example, like a Ford Motor Credit or a GM Credit Company or whatever, some of the dealership type organizations. And that number is continually going down. So I'm not sure how much of an impact, but I do like the idea that we try to keep as much parity in there. And I do think also that, in response to one of the questions that Representative Bear had in there is that my guess is, the dealer or the consumer is going to pay every bit of this stuff one way or the other. So, you go in there into any dealership and they put a little sign on there, and I'm certainly not testifying on behalf of the dealers or Marcia or anything, but they do have a little sign up there that says this dock fees or whatever. Those things will go up because that's not their business. They're going to push the cost down. So to the extent that we can address those issues that Ms. Allen brought up, then I'm very happy to do that. But just like I said, point of clarification, there are just not a lot of state charter banks that are into this area.
Okay. Can we, with the LSO staff, Amanda, Karen, could you guys maybe make a call? I understand our link isn't working properly, or is there issue? Rep Sherwood, that must have been what you had gotten. So Amanda, yeah.
Yes, Mr. Chairman, it should be fixed now. There was an issue with a link in the very beginning, but the link's been updated in the early minutes of the meeting. So if the public chooses to watch via YouTube, they can go to the Wyoming Legislative website, choose watch, and it should send them directly to the YouTube link now.
I'm going to guess there's 50,000 people got up, had their coffee this morning and wanted to hear this discussion.
Pretty sure.
So, okay. Representative Gray.
Yeah, thanks, Mr. Chairman. Ms. Freund, I think that the issue is, we had this on the special session, the first issue too, and I think it's going to continue if we don't, is that it's on the second Wyoming legislative account. It's on the other channel. And so they're not seeing it when they go in the channel, the main LSO channel. It's the only committee it's not that it's not listed there. So that's why I think they're not seeing it. So we might want to try to transfer it to the other channel because that second channel is rarely used. But anyway, thank you.
Amanda, is that comment on that, Amanda?
Mr. Chairman, I was just going to say, I think IT has worked at transferring it once the video started, but if they choose to watch it through the actual LSO website, it should direct them straight to the YouTube channel.
Okay. Yeah, Representative Duncan.
Thank you, Mr. Chairman. So real quick, if we use the link that's on the actual Zoom is that one not active?
Mr. Chairman, Representative Duncan, the link for Zoom is active. So if they want to come in to testify as an attendee, there's no issue with the Zoom link.
No, I mean YouTube. I'm sorry. I mean the YouTube link that you can go up and copy the link for the YouTube. Is that
I'll look into that, but it should all be directed straight to the video now.
Perfect. Thank you.
All right. So we got our YouTube figured out. All right. Hopefully. All right. Let's keep moving. Mr. Meyer, did you have any further comments?
No, Mr. Chairman, and I'd stand for any questions.
Okay, any questions, committee? All right, Mr. Pickard, thank you for your patience, sir.
Oh,
Please.
thank you, Mr. Chairman.
Yeah.
And members of the committee. My name is Dave Pickard. I represent the Mountain West Credit Union Association and the Guaranteed Asset Protection Alliance. I appreciate the efforts that have gone into this piece of legislation, and especially would like to thank Representative Duncan for chairing the subcommittee last fall. And Representative Duncan, you walked through this bill in an excellent manner and very efficiently. So certainly appreciate that too. While the language before you today has been worked these many times, my clients still have just a couple of concerns. And they're small in nature, but I think they're meaningful. And I will get to those in just a minute. But I want to say also up front that our concerns are only a small piece of this bill. As you know, it is going on almost 30 pages or so. And our concerns are right up front with the inclusion of these gap waiver products. That is something that hadn't been regulated by the division under UCCC prior to the discussion that the deputy directors had with the committee. And we appreciate that. We understand that it's an interesting industry, and we understand that there has been some concerns in the past. So let me just mention what our continuing concerns are, and they primarily come about by the amendment that the division offered up in the November meeting that was really an offer in good stead, to alleviate some of the concerns we had. But as we've taken a look at this a little bit further, we want to bring those up today. The first one is on the facilitation of refunds.
Could you bring, sorry, Mr. Pickard, I'm going to interrupt you. Could you get us to the page
Yes.
so that the committee could have that in front of them, please?
Absolutely, Mr. Chairman. I apologize. The first one is on page 2, and it is about the facilitation of refunds. And in particular, at the end of line 15 through the middle of line 18, the duty to facilitate a refund or credit under this subsection shall also apply to voluntary cancellation. We appreciate the effort that we had in the previous meeting. Our concern here is that these contracts between the consumer and the vendor, the gap waiver product vendor itself, not the credit unions, not the banks, and not the dealerships, those offer cancellation at any time for any reason, and those terms are all laid out within the contract itself. So the concern that my credit unions have is that at what point, when a voluntary cancellation that they know little to nothing about, where does their continued obligation to facilitate the refund occur? And keep in mind that my credit unions are going to always support and help their customers and members in their financial transactions. So I would ask, if it's amenable to the committee, that we just strike that last sentence in subsection A there, again, at the end of page 2, line 15, through the word consumer on page 2, line 18. And then the second concern that we have, and we did have discussion about this in the previous meeting, is on the amendment that, and let me get to the right one. It's on page 3, line 8, where it talks about if a default occurs, then the refund may be applied to the amount owing. All of our contracts provide that any refund, regardless of the reason for termination, may be applied to the amount owed. And we just are a little bit uncomfortable having that additional comment or language in there. We understand it's in other pieces of legislation in the insurance code on refunds, but we would be supportive of having that removed. And so the lines 8 through 12 on page 3, you could strike them or just amend the words as a result of default of a consumer, just amend those words out. And then finally, due to the discussion that we had that really brought us to the table to begin with, and that is the refund methodology. We appreciated Senator Rothfuss's amendment allowing for some discretion of the commissioner to set an alternative methodology, or to at least authorize that. Again, our contracts are the ones that are regulating the relationship between the consumer and the gap waiver product provider, and they have a variety of cancellation clauses in there. And that brings me then to which, because of that rulemaking authority that you've granted, I'm very concerned about the effective date being July 1st. Now, if we were to be successful in discussions with the division on refund methodologies, that would have to be adopted through rules. You've got a 90-day rulemaking process, and that certainly, depending on how the legislature handles these bills, my understanding is that they wouldn't necessarily go to the governor until sometime during the March 1st 25-day session. And then you're looking at an effective date that quite possibly is only 2 months, hence the passage and adoption of the legislation. So with that, Mr. Chairman, members of the committee, I think they're friendly amendments. I wish I had them typed up in the appropriate form, but I at least wanted to expose them to the committee today in case down the road, if the committee is not agreeable to those, that you might see them on first reading amendment on the floor. So with that, I'll stand for any questions.
Committee, any questions? I do with respect to, have you considered the ability of temporary rules being in place to help with that timeline? I'm a little nervous about changing an effective date after July 1 is all.
Well, Mr. Chairman, emergency rules, I would leave that to the discretion and for the department or the division to answer. I just know that have a reluctance to jump into emergency rules, and especially when you're looking at emergency rules, this is at the discretion of the commissioner. So we as an industry know from the previous testimony that his refund methodology that he prefers is one that we don't disagree with, but we also want some alternatives. And so that's going to take some time to have those discussions. And they need to be commenced sooner rather than later. And maybe we can deal with that, offline over the course of the next couple of days or weeks, depending on if this bill goes into the 8-day virtual or the 25-day in person.
Yeah, all good points. Representative Bear, you had a question, and then Representative Burkhart.
Thank you. Just a little clarity for my sake. Wouldn't we have to pass this bill for the rulemaking to start? Doesn't this bill allow the division to begin making those rules? So wouldn't we have to pass it first?
So, Mr. Pickard, do you want to answer that, or do you want me to?
Mr. Chairman, my understanding is they don't have the authority to make rules unless they have that authority, and it only comes through the legislation. And in this particular circumstance, I think they have ongoing capabilities to adopt rules under the UTRIP. However, this is new language specifically about refund methodologies on these products. So I don't think that their current authority, I might be wrong, but their current authority probably doesn't extend to these products.
So what I'm going to do is I have an opinion on this, but let's just go ahead and go to the commission and ask them what their thoughts are on the timeline on rulemaking, particular issue on these products.
Mr. Chairman, I mean, what you said is correct. There is the emergency rule process. We did that for the SPDI and some of the digital asset custody to allow us to work out the final nuances of it. So it does exist. The process to Mr. Pickard's probably is start to finish, probably close to 90 days. Technically, though, it's only a 45-day comment period. We always extend it 5 days just to make sure there's plenty of time. So you got a 50-day comment period. So then the rest of it is, and once the comment period ends, as long as a hearing is not required, the rules are adopted as soon as they're signed by the director, with the ultimate ability for LSO review and recommendation to the governor to potentially veto certain or all of the rules. And so, there's ways to do it. As far as timing, it's an interesting year. I think we can all agree on that legislatively to how that fits into the time frame. But there are avenues to do it, and just out of matter of practice, we definitely, if we're writing a rule that impacts those subject to that portion of the law, we deal with the stakeholders before we ever go to a proposed rule. It doesn't do anyone any good to put something out there that's objected to or causes problems. But so that's what I think what Mr. Pickard was saying is could make that process a little bit longer.
All right, Representative Burkhardt.
A question for the division, which is, what's your thoughts on the changes that Mr. Pickard recommended or asked for?
Okay, go ahead. Just start first with the voluntary cancellation. Let's tackle that one first.
Mr. Chairman, so I believe that language was actually added at the request of Mr. Pickard's group during the interim, just to make it clear. When we first drafted that section, we drafted it in a manner that section applies to all credit-related ancillary products, which include debt cancellation waivers. And so in the course of this, then they wanted clarification to specifically talk about the voluntary cancellation or the debt cancellation products. And so I believe, again, on that one, I believe that we added it just for clarification. I think by striking that last sentence in his first recommendation, I don't think that it takes the gap waivers out of the requirement at all.
So that Larry and I recalling.
Mr. Chairman, we broke up. We didn't get your question there.
Okay, Mr. Pickard, I'm just saying that was my recollection as well, is that we put that in our November meeting. What do you recall?
Well, Mr. Chairman, what I recall, and might be mistaken, but what I recall is the issue that I brought up to the division, and Mr. Mulberry and I had an offline conversation about this, is that if you will remember, the original language that was proposed by the division only covered prepayment terminations. And I'd have to pull that language out. So the suggestion was that if you're going to talk about termination of these contracts, it should cover all of the ability or all types of cancellations. And I believe that that is covered in the leading portion on page 2, line 9, where it says 60 days of termination of a consumer credit sale or consumer loan. A creditor shall facilitate any refund. And so the voluntary, the word, if you want to remove the word voluntary, that'd be agreeable to us as well, because then it just covers any type of cancellation, and that's what our contracts say. But originally, the language that was proposed by the division was extremely narrow and only focused on a prepayment termination, not on any of these other cancellation abilities that the consumer has.
Yep. Okay, I got it. Yeah. I see striking that language just makes that cleaner and says all contracts. So, okay. Move us along here. I'd like to get one more bill in before our 10 o'clock break. So this is important. And Representative Sherwood, minerals. This is what we do. We grind out stuff that nobody else wants to do. Okay. Then on the second issue on page 3, line 8, could you address that? Please.
Yeah, Mr. Chairman, on that, and I can let Joe add any extra if we need to. So yeah, as the committee or at least subcommittee members will recall, that was one of the issues of when we came up with the pro rata language originally, we were taking that to be similar to what was under the insurance statutes, and for consistency purposes, that one seems to be the most easily understood by the consumer. We definitely recognize, you know, the risk curve shifts over the life of the credit transaction. And so, you know, I understand that, you know, wanting an alternative method. So again, we need to, what we were trying to figure out though, as we're looking at that internally and how we administer the act, the original proposal was to have something consistent, but then the language that was agreed upon in the subcommittee, which then fed into the interim joint committee, was, as you see here, well, say, well, maybe we work through it on the rule process. Was kind of agreed as a kind of a concession, all parties. I don't know if we have strong feelings one way or the other about that based on what this final language ended up as.
Okay, and so what and Representative Burkhart texted me, said I keep breaking up, and you know, I've done a lot of meetings and I've got good internet, so I don't know what's going on. So I'll do soldier on here. But we're talking about if we have a termination as a result of a default, that any
oh, that's the second. Oh, okay. So
would be applied to the amount owed by the consumer to the creditor. So just want to make sure we're on the right point here. Okay. Duncan.
Thank you, Mr. Chairman. Commissioner Fortner, are you okay with on page 3, line 10, just removing result of default of consumer?
I believe so. Yeah, Mr. Chairman, I'll let Joe handle that.
Yeah, Mr. Chairman, I believe so, right. I think our intention by having that in there is just to make it clear that when we're talking about refunds going to consumers, we just wanted to make sure that there wasn't a situation where somebody had defaulted on their credit transaction. So they didn't pay back their creditor, but yet they had these ancillary products to where there's going to be refunds. We didn't feel like that if somebody defaulted and didn't pay their creditor, they shouldn't be getting a check in the mail for the refund of those products. We were saying we wanted to make it clear that any refund of those products needs to be applied to the amount of the credit transaction that they defaulted on. And so as long as the industry is you know, thinks that it's clear without that, then we're fine with that as well.
Okay. And Mr. Pickard, you comfortable with that?
Mr. Chairman, yes, I am. And again, that goes to the contract language that we have between the consumers and you know, our product sellers. And we appreciate the attempt and the intent of making sure that the creditor is made whole, but those are plenty of safeguards in place through the contract itself, and of course we'll be facilitating that. So appreciate it, and you know, just removing those, I think 3 or 4 words would help us kind of step down on the bill.
Yeah, so I'm sorry to keep dragging this on, but it would seem to me that it would be cleaner all the way around just to pull that whole last sentence. If we're just going to fall back to the contract between the consumer and your customers. Is that, Representative Duncan, would you agree with that?
Yes.
All right. Okay. All right. Any further? I don't see anything further from public testimony for Mr. Meyer, Mr. Pickard, Ms. Allen, Commissioner, anybody have any further comments?
Mr. Chairman, if I might, I have a meeting that I have to tune into, and so I'm going to go ahead and close out. I'll leave the work in the hands of the good committee, and I appreciate everybody's time and consideration this morning.
Okay, thank you. Committee members, any further questions before we close public testimony? Okay, with that, I'm going to go ahead and close public testimony. So we are then on House Bill 08. What is the committee's pleasure?
Move the bill.
Moved by Duncan, seconded by Representative Burkhart. Okay. Let's just go ahead and do this. Let's work this bill page by page. So this will take us a little bit, but it's the right way to do this. Okay. So page 1. Page 2. Representative Duncan.
Thank you, Mr. Chairman. I would like to move amendment on page 2, line 15 at the end, strike the and continue all the way through 16, 17, and 18 to the period other products by a consumer. So the whole sentence would be deleted.
Yep. Okay. Clean amendment. Is there a second? Seconded by Burkhart. Any discussion by the committee? Okay. All those in favor, please raise your hand. Okay. With on the screen, a unanimous consent. Okay. Representative Duncan. Oh, sorry. Okay. Anything further? Page 2. Okay. Page 3. Representative Duncan.
Thank you, Mr. Chairman. I would like to move an amendment on page 3, starting at the end of line 8, and delete that entire last sentence.
Second.
Okay. Seconded by Burkhart. Yeah. Okay. Any further discussion, committee? Okay. Seeing none. All those in favor of the amendment, raise your hand. Okay. Those opposed? Okay, 8-1, that amendment passes. Okay. All right, see anything further on page 3? Okay, page 4. And I got my eyes split, so yell at me if you have an amendment. Page 5. Page 6. 7. Page 8. Okay, page 9, 10, 11, okay, 12, 13, page 14, 15, 16, some of these are cleanup, 17, 18, page 19, page 20, okay, 21, okay, 22, 23, 24, 25, page 26, 27, 28.
Mr. Chairman.
Okay, Representative Duncan.
I'm going to go ahead and throw it out there for discussion purposes, but I have the amendment that I proposed and sent to everyone prior to the meeting on page 27, line, I believe it's line 2 through 3. Let me pull it up here. Lines 4, page 27 after line 3, insert the language D, no fee that would be charged to a supervised financial organization exempt from this part under Wyoming statute 40-14-630B shall be forwarded or charged to a seller, lessor, lender, or assignee, or any other person who would be required to pay the fee on the supervised financial organization's behalf. And inclusive with that, I missed page 4, line 5 to insert after 40-14-630 and insert 40-14-632 by creating the new subsection D that I just
Just the
described.
conforming language, calling it out. Seconded by Representative Sherwood. So everyone understands the amendment. We had significant discussion on this. Okay. Is there any discussion on it? Representative Duncan, do you want to, go to Representative Baird? Do you got a pitch for your amendment? Or
Real quick, the whole idea is that evidently there's a lot of confusion. There's not parity. It doesn't sound like there's a significant amount of money that's coming in and generating with this. So let's make it parity across, and we can always go back and fix it. But this makes everybody equal, and it doesn't sound like the amount is very much. I mean, 4 different. It will be 3, was what we heard on the testimony of people who are assigning. So it's not a significant impact, and it could be used by they're all going to adjust their fees anyway to the consumer as long as it's disclosed. I don't see a reason why we shouldn't make it parity across all the way.
okay, Representative Baer.
Thank you, Chairman. And I do agree with Representative Duncan that it's a small amount, but that is today, and we don't know what direction transactions will go. It could be that state chartered banks get more involved with these types of transactions. So the fee could become more significant. And having worked in a dealership with the finance departments, I do know that the simpler we can make things for them, actually, it could be a better bill if we just make it the same across the board. They're already collecting this fee and paying it to the commission for those transactions that go through a national bank. So this would make their same process for those few state banks that we have now and potentially others in the future. So I think it simplifies it as written, not with this amendment. It simplifies it for those dealerships. Yes, their fees would go up, but those again are passed on to the consumer. So I would be opposed to this amendment.
Okay, any further discussion? Representative Gray.
Thank you, Mr. Chairman. I support the amendment. I think it'll help, appreciate Representative Baer's comments, but I think it'll help the Division of Banking to give us an understanding of what the fiscal impact is when we adopt the amendment, and then on the floor, we can go from there. So I think I'm going to vote for this. Thank you.
Okay, any further discussion? Okay, I'll go ahead. Just go ahead and vote on the amendment. All those in favor, please raise your hand. Keep it up. So we have 1, 2, 3, 4, 5. Those opposed? 1, 2, 3, 4. So that amendment is adopted. Okay, back on the bill. Any further discussion? Amendments on 27? Okay, then 28, 29. Okay, a lot of hard work on this bill, a little somewhat boring, but it's still important in a darn good cleanup all the way around, folks. It really is. So with that, can someone call a question on the bill for me?
Question.
All right, do we require a roll call vote? So we'll have a roll call vote on House Bill 08.
Yes, Mr. Chairman. Representative Baer.
Aye.
Representative Burkhart.
Aye.
Representative Duncan.
Aye.
Representative Ayer.
Aye.
Representative Gray.
Aye.
Representative Heiner.
Aye.
Representative Sherwood.
Aye.
Representative Western.
Aye.
Co-chairman Representative Greer.
Aye.
Mr. Chairman, it passed with amendments.
Okay, so that bill will be passed on to the House floor. So your Minerals Committee's passed its first bill of the 66th session. Okay, so we do have a break at 10 o'clock. So what I want to do then is push on to House Bill 6. I've asked the Banking Commission to present this bill on trust company amendments for us. So this gets started down that path. and if we can bring in Commissioner Forkner and pick up the pace just a touch, maybe. This one, in my opinion, simple. So, but I might be wrong.
Mr. Chairman, again, thank you. Thanks for the work on the last bill. Appreciate it. And yeah, we will make sure and get you back on track. And I know stuff is stacking up on my desk while I'm sitting here as well. So I think we're all incentivized to move this along. So House Bill 6, trust company amendments. I think I mentioned in the interim to some of the committee members that were on the committee at that time that the trust industry, if you will, non-depository trust industry is supervised and subject to Title 13, Chapter 5. And Wyoming over the last 5, 6, 7 years has really become a situs of choice in the U.S. The U.S. has become a situs of choice globally for various reasons. A lot of assets are coming back to the U.S. And in that case, then practitioners look for which situs is best for their client. And for all the reasons that we know are great about this state, is what is forcing us to make sure that our trust company supervision and regulation is appropriate. So while I don't necessarily like to tweak a bill or a statute every year, I think by keeping it modern, we'll keep Wyoming at the forefront. I have on my desk another 3 or 4 applications. We're averaging probably 4 new trust companies a year now in the state. And with that, while it may not replace losses in say coal revenue, there has been a lot of growth in groups that service those companies, attorneys, accountants, plus they're bringing assets to the U.S., some of them real assets through property, things like that. Others have contemplated moving businesses here that are inside of a trust. So there's a lot of indirect benefit for the work that the legislature does every year with trust company statutes. So what we did here, looking at some opportunities and things we hadn't contemplated in the past, and I'll just move through this quickly. Section 1, which is pages 2 through 9, it's new language, and we worked with some industry professionals, attorneys that specialize in this, both in the state of Wyoming and some outside. There's one very prominent firm. I think one of the representatives is going to potentially speak later. The firm that she is with was recognized last year as top in the nation in this area of expertise. And they send a lot of business to the state of Wyoming in both regulated and unregulated companies. But what we found out is we didn't have statutes that addressed mergers and acquisitions of trust companies. And again, it was really nothing that we needed to worry about in the past, but now we've had a few companies that are starting to look at those opportunities, and those opportunities are presenting themselves to maybe acquire another trust company chartered in another state for various reasons. And so we didn't really know how to handle that transaction. So that's what pages 2 through 9 do, is it makes it clear on how an existing trust company chartered in the state of Wyoming would handle a merger or an acquisition. And, South Dakota is probably one of the top, if not the top jurisdiction in the U.S. for trust companies. So we work closely with their division of banking and their trust company expertise. And so some of our language is modeled after that. Some of it's some things that we thought would be advantageous for the state of Wyoming. So that's what that new language in section 1 does, is just lays out how they walk through that process.
So Commissioner Forkner, I did have one quick question, and I may have asked this before and forgot, but on page 9, section 3, lines 11 through 13, we're talking about the resulting trust company after a merger shall not maintain more than 2 trust company branches in other states. What? And I just can't remember the reason of why only 2 branches.
Mr. Chairman, and yeah, I'll have to try to reach back in the recesses of my brain too as well. So with the committee, especially the new members, want to give you a little brief backstory on this. Is so up until I think last year or maybe the year before, when we passed a comprehensive restructuring of the statutes regarding trust companies, branching of a trust company was not allowed. And there's some discussion out there amongst professionals and practitioners. Should Wyoming allow trust companies to branch into the state, to branch out? And so I would say there's not consensus there. They did, if memory serves, we did allow for in-state branching. So if, let's say you've got a trust company in Jackson where a lot of them are, but they wanted to put an office in Cheyenne, to allow for full trust services. You know, they can do a representative office. Representative offices are restricted on what they can do. Pay bills, things like that. No real fiduciary activities. It's very much administrative. But they could actually generate business and underwrite the trust documents out of a branch. And so they're allowed to do that in here. Well, what happens if you acquire an institution outside the state of Wyoming? Well, you are allowing a branch, but we want to make sure that it doesn't just open up the floodgates of a sort of let's crawl before we walk. And so the thoughts also being that, practically speaking, the chances in an acquisition of there being more than probably 2 facilities within that acquired institution, would they need those to be, in essence, a full service branch? There's still an opportunity. Let's say they had the main structure, main facilities in Massachusetts, and they had a branch in Maine and one in New York. They could designate one of those as a trust service office, which could do administrative. Maybe they've got their accounting arm set in New York or something like that. So that was the thought there, is we didn't want to just open up branching because we thought there was an avenue for that.
I recall the discussion now. I was just having difficulty. I think the key is that we're allowing branching out, not branching in. So yeah, Representative Heiner.
Yes, thank you, Chairman. A follow-up to that question, then, if there was a merger or acquisition between a trust company and they acquired another trust and had 2 branches, that would prevent them from doing any more acquisitions because they already have 2 branches outside the state. Is that, am I missing the mark there, or is that the way it would be?
Commissioner?
Mr. Chairman, Representative, I believe so, because right, they've already established 2 branches, and maybe that's something I hadn't really contemplated that, kind of serial acquisitions. I'm not sure if that's an issue or not an issue, but that could be a limiting factor. Or the other one is, again, would they need those to be branches, or would they be able to make those trust service offices where it's just administrative only? That is a good question. And so I think we would want to, maybe that's something we continue to chew on. Right now, it's not a pressing issue, but doesn't mean it wouldn't come up in the future.
Okay. All right. Good question. All right. We'll keep moving.
Yep. So, Mr. Chairman, so Section 2 is we have the Division of Banking regulates 25 state chartered banks. There's 30 banks that are domiciled in the state of Wyoming. 5 of them have a federal charter. 2 of those are federal thrifts or savings banks. And then we only have 3 national banks remaining. So for various reasons, I think that some of the committee members may recall 80% of all the banks in this country are state chartered. But anyway, so we have 25 state chartered banks. Once we get through these applications I mentioned earlier, we'll have 22 state chartered trust companies. And all de novo charters of public trust companies and banks, of course, SPDIs, things like that, go before the state banking board. And that's statutorily created. You'll see the language with the amendments. So we thought it's probably time to have representation of a trust professional on there, given that the assets under management now are getting decent size for Wyoming. Nationally it's still a small amount, but we got to be getting close to 15 billion probably, which if you put all banking assets together in the state, we're at about 10 billion. 12 billion maybe. So there's definitely that. So we want a representation, decided, try to figure out what's a good fit. So we said, well, at this point, let's just add one more member to the board. So there are currently 7 members appointed by the governor, and then the director of the Department of Audit is an ex officio member. So it's currently an 8-member board. And so we're proposing that this adds 1 member from a public trust company. If you look at the statute, we have chartered family and we have public. chartered family applications don't go before the board, so figured they didn't need to be represented. And then the other thing is, while we were looking at this section, we're tweaking the language. You'll see on lines 8 and kind of 9, but really 8, because we have such a small number of national banks. It's getting to be more and more difficult to get a representative from a national bank, or, and it's usually senior executives or the presidents of these organizations that sit on the board. And, they'll spend a couple terms on the board and then come off. Well, when you only got a small number, it doesn't take long to be recycling through that. And it can be a heavy lift. So what we said is, let's remove the differentiation and just say it should be at least five bankers, whether it's state or national. And then we'll still maintain our 2 individuals that represent the public at large. And then we'll add the trust company. So that's what this page does. Mr. Chairman, page 11. This is another issue, as we've become a more popular situs of people that form companies outside, maybe an unregulated trust company, or maybe they're regulated and want to move to Wyoming. So they've already been formed in another state, and so this here is expanding the definition of trust company to include foreign trust company that already formed outside. Because if you read through our statute, it's not clear that if you're in existence already, but you want to now become subject to Wyoming supervision, that existing entity, would it have to dissolve itself or not? So we said, well, let's just make it clear they don't have to dissolve itself. They'll still have a presence here and all of that. It's just the corporation was formed, usually in Delaware, honestly. Page 11 as well. This here, this section, start lines 14 through 18. This gives the ability to direct a trust company, a failed trust company, to bankruptcy court. And the thought was there now, so banks are exempt. They can't go claim bankruptcy. Trust companies can. So what we were trying to do is, what can we do to shield the state of Wyoming? So if we become a receiver of a failed trust company, and I've shared with some of the community members, there's horror stories among my colleagues out there that have done this, especially larger ones. It costs the state massive amounts of money. We're trying to build a buffer, but I would say we're not fully protected. This here, if it's in the best interest of the state of Wyoming to have them go to bankruptcy court, have the court resolve through that, find successor trustees, things like that, that option would exist. So that's what that language is there. And again, hopefully I don't have to deal with that during my career. Hopefully we were doing our job supervising them, and then no fraud that takes one down, but wanted to have that protection in place for the state of Wyoming. And then also talking about the formation of companies, so bottom of page 11 and spilling over to page 12, that they don't have to go through, basically you don't have to go through and reform in Wyoming. That we can take that existing formation, corporate documents that were already established, and then therefore, because again, if you read this in context, it would imply that they would have to form a new corporation. Mr. Chairman, then going on to page 12, it talks about just being able to recognize virtual meetings. Again, it's not clear whether they have to be in person or not. And so given the fact that we were all shifted to this virtual reality that we've lived in for a year now, just wanted to give the authority that they can actually hold virtual meetings, that they comply with the statute of holding their board meetings. And with that, Mr. Chairman, that takes us to the end of the bill, and I'll stand for any questions.
Committee, any questions? Okay, why don't we, can I see, we've got, let's go ahead and let in. We've got a little bit of time here. We'll do what we can before 10. So Scott Weaver, Scott Meyer, did Elise McGee wish to come in and comment? I don't recognize any other names associated with this, but okay. So, Scott, if you've got some quick comments, or if you don't, we'll come back later and address them. Yeah, Mr. Meyer.
Oh, thank you, Mr. Chairman. All I heard was Scott. I didn't know if it was Weaver or Meyer.
Sorry.
Scott Meyer with the Wyoming Bankers Association. I just wanted the committee to know that we stand in support of the commissioner's bill. We've had lengthy conversations about the need on the board and the regulation of the trust companies. And as I say, we stand in support of this bill.
All right, thank you. Any questions for Mr. Meyer? Okay, this go with Ms. McGee. Welcome.
Hi, good morning, everyone. I thank you for allowing me to speak today at the hearing. I'll be brief. My name is Elise McGee, and I'm a partner at McDermott, Will & Emery. I'm based in Chicago, actually, but McDermott is an international law firm. We have 13 offices in the United States. And I'm here today as really a member of the Wyoming Bar and to talk to you a little bit about this trust company legislation and really to give you some insight on kind of how this compares or what Wyoming is doing relative to other jurisdictions in this area. I've advised clients for many, many years on the formation and operation of trust companies in probably over half the states. So I see legislation, trust company legislation in well over half the states. So that's really my perspective. I've worked with close to probably 100 families and companies who are exploring and in fact have formed trust companies in these jurisdictions. And so it is important to me to be able to represent to my clients that Wyoming, for those interested in exploring Wyoming, it's really at the cutting edge. It's really has an active legislative presence. It's really, you know, thinking about how to even be better than what it is now. So these folks really pay attention, honestly, to the legislative bills that come down. They're ultra high net worth families and individuals who are attracted to Wyoming, not just because of the favorable income tax, but also, or lack thereof of income tax, but because of the location. And really, they're looking at Wyoming as a jurisdiction to establish a relationship. They want to know that the state representatives, the regulatory agencies are supportive of trust company operations. They don't want to establish a trust company in Wyoming and then find that, you know, the support of the legislature isn't there after all. That this isn't an industry that matters to the state of Wyoming. So this is a key consideration for them. And I think what they found with some of the recent bills, you know, Commissioner Faulkner referred to the 2019 trust company legislation, this digital asset legislation that just went through, some of the recent amendments and updates to the Wyoming Trust Code itself. These are all good indications that to these families and companies that Wyoming is a jurisdiction that's a key contender and really is at the forefront, I think, cutting edge of all states in terms of its progressiveness and of this and acceptance of this as an industry. So I think this is going to continue to grow the trust business. I think Commissioner Faulkner may not appreciate this, but I've had in the past 6 months about 9 clients choosing or in active discussions wanting to establish a trust company in Wyoming in 6 months. And I've had just as many, if not more, clients opt into Wyoming as a jurisdiction for their trusts, you know, their dynasty trust, any sort of trust, because they appreciate the legislation and it works for their family. So I think the legislation before you is another example of Wyoming's forward thinking here. With the growth in the trust company business, there will undoubtedly be trust companies that wish to merge. We've seen that. I've had one client right now that's talking about that and thinking about that actively. And having procedures in place creates those opportunities. And especially as Commissioner Faulkner mentioned, these out-of-state trust companies that wish to move their business to Wyoming, they recognize that they maybe can't even compete in the jurisdiction they're in now. And that could be because of trusts are taxed in some jurisdictions like California based on the residence of the fiduciary. So if you're hiring a California trust company, potentially you're opening your trust to taxation in California. So why in other jurisdictions as well? So why not hire a fiduciary where it's very clear, a Wyoming fiduciary, that hiring that fiduciary isn't going to create an income tax problem for you? So again, the trust business in these other states are looking at and eyeing Wyoming and saying, you know, maybe we need to think about expanding operations into Wyoming. Maybe we need to move our charter here. And so I think, again, we'll see a number of these trust companies express interest, and really what we're not trying to do, of course, is push everyone to Wyoming. It's not necessarily jurisdiction for everyone, but for those that are in the space and really appreciate what Wyoming has to offer, this creates an opportunity that I think is valuable to Wyoming. So with that, I'm happy to answer any questions, even specifically about this bill before you.
All right, well, thank you. Any questions for Ms. McGee? None? Okay, hey, we appreciate your comments, and you know, push more to us. We appreciate it. So.
Thank you.
Mr. Weaver, and I understand you just assumed a new post. Is that correct?
Somewhat recently, and thank you, Chairman Greer, for the recognition. I am the General Counsel and Chief Fiduciary Officer at Willow Street Group and Willow Street Trust Company, and I've now been in this role since June of 2018. And Willow Street is a founding member of the Wyoming Trust Association, and I'm one of the directors of the Trust Association. So this morning I'm appearing both on behalf of my colleagues at Willow Street as well as my colleagues at the Wyoming Trust Association. As Commissioner Faulkner noted, the financial services industry and the trust industry in particular remains a bright spot in our state economy. And we've experienced robust growth owing to the factors that Ms. McGee and Commissioner Faulkner have identified, and believe that we're on the forefront of jurisdictions for wealth transfer planning. Both the Wyoming Trust Association and Willow Street support strong and effective regulation to ensure the continuing safety and soundness of the banking, trust, and financial services industry. And further, to empower the Division of Banking and Commissioner Faulkner and his staff to effectively steward our jurisdiction. This financial services industry generally, and the trust industry in particular, offer positive economic and employment benefits to the state of Wyoming and its citizens. For example, our firm Willow Street hired 8 new full-time professional staff during 2020, representing a 30% increase in our total staffing, COVID notwithstanding. And as Commissioner Faulkner noted, we collaborate with Wyoming-based attorneys, public accountants, asset managers, and depository institutions. For example, our firm works closely with McGee, Hernan Pies, and Cheyenne, and our clients hold deposits in local state-chartered banks and other financial institutions. So we believe our industry provides spillover benefits to other professional service businesses in the state. There's 2 key parts of House Bill 6 in particular that I'd like to highlight. First, we believe that Commissioner Faulkner and his colleagues at the division would benefit from clearer statutory authority to further enhance the division's supervision of regulated trust activity within the state. And the proposed section 13.5.426 that the commissioner discussed and related amendments are in furtherance of the division's objectives and provide the commissioner and his staff with clear authority to oversee and regulate mergers of trust companies. Second, we are in favor of the proposed modifications to 13.1.604 to provide for a representative of the trust industry on the state banking board. As Commissioner Faulkner noted, that board is presently comprised of representatives from the depository banking industry, and our belief is that adding a representative on behalf of the non-depository trust industry will bring subject matter experience and expertise to the board in recognition and furtherance of growth in the industry. In closing, I appreciate the opportunity to speak to you today and to speak in favor of House Bill 6 and urge its adoption. And I'll stand for questions from the committee at this time. Thank you.
Well, thank you, Mr. Weaver. Committee, any questions? Representative Western and then Heiner.
Thank you, Mr. Chairman. Mr. Weaver, you said some of your clients hold some of their assets in state chartered and Wyoming chartered banking institutions. Could you give us a figure of what percentage of your clients do?
Yep. Go ahead, Mr. Weaver.
Thank you, Mr. Chairman. Representative Western, I don't have statistics in front of me. I would say the vast majority of our clients have at least some depository presence in Wyoming. Our clients often hold local accounts for operating accounts, and that is in conjunction with assets that are located nationwide and globally. But I would say a majority to a strong majority of our clients have at least some local banking presence. And then in addition, of course, there's relationships with local advisors, be it attorneys, public accountants, asset managers, et cetera.
Okay. Representative Heiner.
Thank you, Chairman. Going back to my earlier question about the limitation of outside branches, I can see that where this trust expansion is a great economic boon for the state. We're hearing testimony that they're growing and it's becoming on the cutting edge. But will this limitation of only having 2 branch offices limit the growth in the future for these trust companies? Or would it actually be a benefit such that Wyoming doesn't become just shell companies of trust companies and they have their bulk of their business outside the state? So I'm kind of torn between those 2 options. Do we want them to set up shop in Wyoming and limit the number of branches they have such that they focus their attention here in Wyoming? Or do we let them grow a little bit more so that they can continue to grow the business here in Wyoming? So just maybe Mr. Weaver could answer that from his standpoint.
Sure. Mr. Weaver.
Certainly. Thank you, Mr. Chairman and Representative. Speaking on behalf of my role at Willow Street, we have 1 office in Jackson. We don't have any other trust offices or formal branches, nor do we have any intention of expanding at this time. I can't speak on behalf of my colleagues in the industry not being aware of their strategic growth plans. But I think, Representative, you raise an important question as to how best to serve, and I trust the committee will address that question and use its good judgment. Which is another way of saying I don't have an opinion on that matter.
Yeah, you just throw the ball back to us. We'll work on that. You bet. Okay, committee, any further questions? Okay. Well, thank you. Again, we appreciate your comments, and Ms. McGee, thanks for joining us as well. I'm going to go ahead and end public comment. I'm running a few minutes late, but I think we'll be able to work this bill relatively quickly for a clean spot before I break. And Representative Sherwood, you're fine with that? Okay, thank you. Representative Ayer, did you have a question?
Thank you, Mr. Chairman. I do. I think this is probably best addressed by yourself. I'm asking about on page 11, section 417F, which allows the division to require a trust company to file bankruptcy.
Yeah.
Is that common, or does that create any problems giving them that authority?
It is not common. And if you recall the discussion from November, I questioned this heavily. We fleshed this out. And really, as we're standing up, we don't, especially with the supervised trust that we have with the family chartered supervised trusts, right, where they can opt in to be supervised. We don't have that big reserve built in there. And
right.
So if the trust were to fail, and for the commission to step in and then manage those assets and take that through the liquidation deal with with whatever creditors might be there in that orderly dissolution, we're a little nervous about the reserves we presently have. They are building. Okay, so one of the options I thought in this gap was, because trusts could be pushed into a bankruptcy, was to use that bankruptcy court, which is a very effective means of liquidation and satisfaction of debts and the resolution of all those issues. So it was, I accepted it as maybe an intermediate stopgap measure that in 5 to 10 years, maybe we'd come back in, look at it, and not worry about it. So hopefully that answered the question.
Yeah, it does. And I agree with the provision. I think it's good to have that protection in there. I was just wondering if we were in any trouble giving the division that authority.
Yeah, do it and then beg forgiveness, right?
Sounds good.
Okay. Representative Sherwood. You're on mute. You're on mute, Representative Sherwood.
Thank you. Thank you, Mr. Chairman. I have a question just for clarification on page 4, lines 8 through 11. It discusses the process of merging and looking at current fiscal year and each of the 4 preceding fiscal years. I don't know how often this would happen, but what happens if there's a trust that's involved in a merger that's less than 4 years old?
Yeah, so I don't know the answer to that question, and I think we did close public comment, but Commissioner Faulkner, could you answer that real quick for us?
Mr. Chairman, Representative, yeah, and so what it would be is we would just take whatever financials are available there. So this is really just to get a sense of the standing of the company. Obviously, if they're only 2 years old, we'll just take the 2 years. But if they're a 10-year-old company, we want to be able to look back for.
Okay.
Thank you.
All right. All right. What is the committee's pleasure?
Move the bill.
Okay. It's been moved by Duncan, seconded by Representative Ayer. Okay. Everybody satisfied? We'll work this bill real quick and then take our break. Okay. Page 1. Page 2. 3. Page 4. Clarifying language. Are we good with that? Okay, all right, page 5, page 6, page 7, page 8, 9, page 10, 11. You good with that, Representative there? Okay, page 12. All right, that takes us to the effective date. Any further discussion on the bill? Okay, question being called. We'll go ahead and take a roll call vote on, what are we on, House Bill 6?
Yes, Mr. Chairman. Representative Baer,
Aye.
Representative Burkhart,
Aye.
Representative Duncan,
Aye.
Representative Ayer,
Aye.
Representative Gray,
Aye.
Representative Heiner,
Aye.
Representative Sherwood,
Aye.
Representative Western,
Aye.
and Chairman Greer.
Aye.
Chairman, the bill passes.
Okay, we'll move that one forward. That is a bill that I will have earmarked to run in the virtual session, definitely. So should be a nice, simple bill. And if you're interested in floor managing it, let me know. The floor is tired of hearing me talk about trusts, so I'll be more than happy to pass that duty off to somebody else. Okay, so with that, what we're going to do is we're going to break till 10:30. We'll start back up at 10:30 sharp. And with that, we'll take up the next bill that if it passes this committee, that I would like to see in the special session, and that is House Bill 9, short-time compensation. So with that, we'll be in recess until 10:30. Thank you. Chuck, I can tell I'm turning into a dinosaur. If I'm not holding paper, I just don't feel effective. This working off a screen.
No, I've got all these windows open, and I should have. I like printing the bills out.
Something therapeutic about it, maybe. So, okay.
Chairman Greer, I'm with you on that. The only problem I found today is that my printouts with all my notes on it have been updated, so my line numbers aren't correct anymore. I'm going back and forth. I'm really ancient of days.
I understand. Okay, so we've got 1, 2, 3, 4, 5, 6, 7 live. Representative Duncan's picture and Representative Western we're waiting on. So Amanda, if you're available, can we go ahead, just go ahead and let in, so I see Director Cooley. I don't know enough of the other folks, but let in the folks from Workforce Services, get them teed up.
Yes, Mr. Chairman, we'll get them in.
Okay, I see they all raise their hand. Thank you. They're all much more experienced at this than I, so everybody's got it down better than I do. Okay. I'll wait just a little bit more for Representative Duncan Representative Western, sorry. I confuse those two all the time. Okay, well, let's go ahead and we'll start back up. So the next bill for our consideration will be House Bill 9, which is titled Short Time Compensation. And I've asked Director Cooley and her staff to walk us through this bill. But before we do, I want to do just a little quick overview of where this idea came from and just set a little bit of the stage for it. And so I always called this work share rather than short time compensation. But I was visiting with a gentleman that owns a business much larger than the one that I run, and then a friend of his who has convenience stores scattered throughout the state. And when this all hit with the pandemic and the layoffs and all the stuff that occurred, the discussion revolved around what happens in other states and what's available in other states. And this idea here is that an employer, and it's at the employer's option, and you'll see as we go through this bill, can contract with the department. And instead of having, let's say you've got to cut back employee expenses by 20%. Instead of laying off 20% of your workforce, you have the option to enter into a contract and keep your full workforce, but idle back their hours. And maybe you have to idle them back 25% to make the dollars match up on your balance sheet. But those employees continue to be employees with the benefits associated with a full-time employee, but then they can apply for the unemployment benefits for those hours that they're missing and be made whole. And the benefit that I see, and this is now me speaking more as an employer than a legislator, is that I get to keep my employees. I get to keep the people that I've trained, the people that know our business, and they can continue to work. And it provides me an efficiency. Now, whether I want to do that for the long term or not is going to be a question I have to decide. But at least in a short term, a 2, 3, 4, 5 month window, it is a great opportunity for me to have to be able to maintain and keep probably my most valuable resource, which is my employees. And so that's why this bill came out as a mechanism to do that. It is clearly at the employer's option. I'll let the department speak to this, but it is my understanding that it is actually a savings to the unemployment trust fund. And I say that, but I don't know that exactly. So that's sort of my layout and why I like this bill, why I'm excited about it. And so with that, I'm going to be quiet, and then I will ask Director Cooley to go ahead and come to the forefront.
Thank you, Chairman Greer, members of the committee. My name is Robin Cooley, and I am the Director of Wyoming Workforce Services, and it is a real pleasure to be here. And I want to welcome all the new legislators, and we're all looking forward to working with you on this and many other bills in the future. What I would like to do, Representative or Chairman Greer, we hadn't planned to walk through page by page. If it's all right, what we'd like to do is give a real general overview of it, both the substance of the bill, but also the funding options that we have available. And then I will speak to the issue of I've got some good news as it relates to the position that we've requested. So with your permission, we'll move through it like that. Is that acceptable?
It's fine with me. Thank you.
Okay, thank you. Thank you very much. What I'd like to do first then is introduce the people the real experts that I've got here in front of you that will be helping me do that, and will in fact be doing most of it for us, because they are the experts in the UI unit, the division, and that it's a complicated area, and I think they will do a very good job of giving you a review of what this bill does. First, I've got Chris Funk. She's the Deputy Administrator in UI on the tax side. And as you'll hear, we've got actually two sides in the office. We've got the tax side, which is the side that works with businesses and talks about with these businesses tax rates and those types of issues. And that will actually be the side where the application process takes place. I've also got my administrator, Holly McCamey Simone. She's the administrator over the entire unemployment insurance division within the office, as well as others in the office. But she will also talk to you about funding opportunities that the Department of Labor will be providing for us to implement this program. As well, I've got our CFO, Kristen Burkhardt, available in case we get into the weeds with some of the funding issues. She's there to help us out because some of it gets a little complicated. So with that, I'm first going to turn it over to Ms. Funk, who can explain the substance of the bill and what it actually does. Go ahead, Chris. Thank you.
Ms. Funk, go ahead.
Good morning, Chairman Greer and members of the committee. My name is Chris Funk, and I am the Deputy Administrator of the Unemployment Tax Division within Workforce Services. What we wanted to do, as Director Cooley said, we wanted to help you understand the purpose of the bill. And we thought the best way to do that was, in case someone wasn't real familiar with the UI program, we wanted to give an overview of the program and a couple of scenarios on how the current benefit process works and how it would change with the short-time compensation program. I believe we provided a document for you, and that's basically what I'll be speaking to. The purpose of unemployment insurance is to provide temporary payments to individuals who are out of work. When the benefits section receives a claim and they make a determination, there's a couple of things that a claimant has to meet to qualify. And the first is they have to have lost their job through no fault of their own, and they have to be able, available, and actively seeking work. The second qualification that they have to meet is monetarily, and that means they have to have a minimum wage amount in the base period. That changes every year and runs on a fiscal year. So in July, it will change again, but currently it's $3,950 in that base period. I believe there's a chart further down in the document that explains how the base period works. Currently, the minimum weekly benefit amount is $38 and the maximum is $526 per week. How is it possible for them to receive benefits? So on the tax division side, employers report employee wages and pay applicable taxes quarterly. The taxes that are paid by the employers go into the UI trust fund that is to be used to pay benefits. The taxes are based on tax rates we're not going to get into a lot of detail about how the tax rates are calculated today. We could spend a whole day on that. But if you guys are interested at any time, we can set up something or provide something to you to help explain how the tax rates are calculated. There are two types of rates. New employers receive an industry average rate for their base rate. And those employers that have at least 3 years of wage history with us get what we consider to be an experience rate. And that's based on their benefit charges and taxable wages. That's where this becomes important about how much benefit charges are assigned to an employer. Currently, if an employer determines that they need to reduce their payroll expenses, we pretty much have two options. They can reduce an employee's hours 100% or by laying them off completely, or they can reduce their hours and still allow them to work a certain percentage. We showed a couple of scenarios there with option 1 and 2. Currently, the way that works, as you can see, there's not a lot of positives that come out of either of those situations. It does solve the problem of the reduction in payroll expenses for the employer, but it also jeopardizes having good employees, and it is a hindrance to the employee themselves. So the difference would be with the short-time compensation program is the employer would submit a plan to us, and in that plan, they would provide information about who all of their employees are, what their regular work schedules would be, up to 40 hours per week. So it wouldn't include overtime. And it could include alternative work schedules. So it doesn't have to be like a basic 8 to 5. It's just what is their 40-hour week. In the plan, they have to name at least 2 employees that they want to cover under the plan. The reduction in their hours has to be between 10% and 60%, which when we wrote this originally, we made that pretty broad. A lot of states have shortened that up, but we felt we wanted to create the most opportunity possible. And then lastly, they have to enter the length of the program, which cannot be more than 12 months. They have to certify several things that they agree to, specifically that they will not lay off those covered employees and that they will retain the health and retirement benefits for those individuals. So on the STC program, option 1 that we used above is not available, obviously, because they would be laying everyone off 100%. Option 2 is a great scenario with the 30%, because as you can see, the difference is that the employee can now collect partial benefits. So in the other situation, they were still making $700. They were over the max weekly benefits, so they didn't qualify in the monetary part. They get to retain their health and retirement benefits the same as they were when they were working full-time. Also, because the amount of benefit charges that would be assigned to the employer in comparison to option 1 above, that means a smaller potential rate increase for that employer. So as you can see, it's a win-win for both the employer and the employee through employee retention benefits for the employee, health and retirement benefits, and potentially less impact on the employer's tax rate. And yes, as you said, Chairman Greer, that also is less of a hindrance on the unemployment trust fund.
Okay. Committee, any questions? Ms. Funk, you must have done just a spectacular job explaining that. Okay. So Director Cooley, how did you want to kind of take us, or have somebody take us, we go page by page pretty quickly on this. I mean, a lot of this revolves around the parameters and the nuts and bolts of getting the contract put in place. But, and then I think we do need to, when we get towards the end, we're going to want to discuss sort of the administrative impact, the funding, the position, that type of stuff. And unless you want to address that first, or I'm going to leave it up to you, whatever you'd like to do.
Okay. Thank you, Chairman Greer. I think, and I think I wanted to clarify a last point that Chris made, I think I heard you say when you're talking about that last option, that really is option 3, which is the STC program, the short-term compensation program, not the option 2. So just to clarify that those are the benefits that employers and employees would see as it relates to this actual program.
Okay, Representative Gray, did you have a question then?
Yeah, thank you, Mr. Chairman. Appreciate the presentation. Is really well done. I've always, been on enough committees. You see a lot of agency reports, and I always think DWS is one of the best. So appreciate the background. What happens if the employer decides to lay off the person and backs out of the short-term agreement?
Go ahead, Ms. Funk.
Thank you, Chairman Greer and Representative Gray. That's a great question. So in our agency, we've talked a lot about this, and absolutely we plan to be very flexible with employers. According to the bill, the employer would have to notify us, but we have agreed, and if necessary, we can clarify some of that, possibly through commission rules as to, the time frame that they have, how much notice they have to give us. But we will be flexible with those employers. If say, in the next couple of days, they know they need to let that person go, they can come back to us and request that then an amendment to that contract be made. And we would absolutely be flexible with that, because if we're defeating the purpose of what this is for, because things can change from day to day, and we understand that.
So Representative Gray, it's a good question. And I guess I had the understanding that if an employer would still be allowed to terminate an employee for cause. That is, they don't show up for work. That doesn't prohibit that in these agreements, does it?
Chairman Greer.
Yeah, go ahead, Director.
If I may, just to add on to what Ms. Funk indicated, if you look at, we've got a provision in here where it talks about modification of the plan. And I think that situation would probably fall within a modification of the plan. If you need to let an employee go for cause, you can let them go for cause and simply submit a modification to the UI commission, or to the UI folks, and that modification would be an easy response, I'm sure. But again, we would still need to make sure that we're within whatever the parameters are, the 10% and the 60%. But if that wasn't an issue, then that would certainly be something that would be, it seems to me, an easy fix.
Okay, I'm going to follow up on that, but I'm going to go ahead and let my committee ask questions. So I got Representative Western and Representative Bear.
Thank you, Mr. Chairman. Piggybacking off Mr. Representative Gray's comment, or question, make sure I understand this clearly. So if let's say my employer comes to me and they need to cut back my hours, and this short-term compensation option is available, we go down that road, but things change a few days later and they have to terminate me outright through no fault of my own. We simply just revert back to option 1 on the PDF that you guys sent prior to. Is that correct?
Whoever, Red Director.
Chairman Greer, Representative Western, that's my understanding. And Chris, please help me out with this, because she's done a lot more research on this than I have. But yes, the options for terminating employees are definitely in here, and we would make sure that scenario is addressed in rules. But that we've got in the legislation, there are provisions for modification of the compensation plan. But I also want to point out, in the legislation, there's clear flexibility in this plan, where if you need to completely stop an existing plan because something's happened and you need to initiate a new plan, that is, it's clearly stated in here that you can do that, and it's fairly simple to go ahead to go through that process. So I wouldn't see any problem with that scenario at all.
Okay, follow up, Representative Western.
Thank you, Mr. Chairman. So let's say I work at a sugar mill. Let's just go ahead and say my boss says, actually, you know what? You're on plan number 1, which is the short-term compensation plan. We got to shift you we got to let you go entirely. Would that create or what would the administrative burden be for the department and for you guys to switch over those plans?
Director?
Chairman Greer, and for the administrative burden, I'm going to ask Chris if she can speak to that issue.
Chairman Greer, Chairman Greer, Representative Western. The reason that we would have to know that is because when we receive the plans on the benefits side, those particular claimants will be earmarked as STC plan claimants so that they get paid. Because otherwise, if they stayed in the path of a regular claimant, they wouldn't get paid because they would be over the monetary amount in a lot of cases. So if we found out that the plan was changing and was modified, then we would move those claimants out of that STC plan, and then they would follow down the path of a regular claim. So the process, because they're going to get paid a different amount, correct? How their monetary or their weekly benefit amount is going to be calculated completely different. The other thing is the reason that we need to know about the plan changes is we're going to monitor those individuals and make sure, because they still have to report the number of hours they've worked and the pay. And if that deviates out of that plan, we will get in touch with the employer and potentially terminate the plan because they're not following it. So that's what the system will be doing, is monitoring those individuals, and it will be determining how their weekly benefit amount will be paid. So it's two processes. Does that answer your question?
Mr. Chairman, Ms. Funk, it does. Thank you.
Yep. Okay. Then I had Representative Baer. Did you still have a question?
Thank you, Mr. Chairman. My question is for Ms. Funk. And I want to echo what Representative Gray said. This handout was very helpful in just making this bill a lot clearer to me. But I do have one question about the handout. On page 3, at the top, it's talking about the employer certifying various things. And it says that they certify that the plan will not exceed 12 months. And then when we get down into option number 1, where we get into an STC plan, it says the length of the STC plan is 12 weeks. And I just would like some clarification there of what is the difference between the 12-month period and the 12-week period. Thank you.
Ms. Funk, go ahead.
Chairman Greer, Representative Baer, that's a great question, and I apologize. That's kind of confusing. So when I was writing up the STC portion, I was just comparing option 1 from above and below. So it was basically the same thing. So option 2 was using the same scenario as above. So the maximum amount that length that they can do is 12 months. So they can do a plan of 12 months. I was just doing that example of 12 weeks in, say, for example, they laid that person off, or they shortened their hours 30% for 12 weeks. So I apologize, that was kind of confusing.
Okay. Did that, yeah, Representative Heiner.
Thank you, Chairman Greer. As a prior business manager, I really like this approach to give us the opportunity to retain employees, because I know the cost of retraining, finding a valuable employee, and the time lag for them to become valuable contributors to your business. But as I managed personnel over multiple states, this option never came up before. So is this on the cutting edge? Is it specific to Wyoming, or have other states attempted this in the past, or are they implementing this in the past in other states that we can look to for some examples?
Good. Go ahead, Director, or Ms. Funk. Yeah.
Chairman Greer, this program was active in a number of states, although it's our understanding prior to the pandemic, it was not utilized very much. For instance, in Colorado, I think they might have, leading into the pandemic, maybe had 3 businesses taking part in this. Since the pandemic, this program has absolutely skyrocketed in popularity. Now, part of that might be because if you already had it in place, you had some money from the CARES Act funds in order to help pay some of those costs. And of course, unless that is extended at the end of March or middle of March, those funds will no longer be there. But I recall hearing it was Maine or Rhode Island had similar numbers. They had something like 2 or 3, and they've got thousands of businesses that are taking part now. So we absolutely have the opportunity to look to other states with some of the questions, some of the issues that they're running into, to try to head those off in our rules as we move forward. And we're getting, more and more information also from our Department of Labor partners as well on this. Department of Labor is fully and 100% behind this particular program because it is so beneficial both to employers and employees.
Director Cooley, on that point, this pandemic has kind of driven this idea to the front to be utilized, but Wyoming is famous for its boom and bust economy. And so maybe it lends itself better in some of our, in Wyoming, maybe better in other states, quite frankly. Your thoughts on that?
Chairman Greer, members of the committee, I think that's absolutely correct. And for whatever reason, and we've really tried to ponder this and think back through the history of unemployment in the state, we're really not certain why it wasn't implemented sooner. It does seem to be a program that at those various times could really take off and really help business during some of those up and down times. So we're just not really certain why it wasn't implemented here, but we're just not sure on that point.
Okay, committee. All right. We were discussing, I don't know, Director, if you wanted to talk about sort of more of the fiscal or the administrative impact, or go through the bill. This probably talk about the administrative impact and the costs, and then we'll work our way through the bill.
Thank you, Chairman Greer. And for that, I'm going to turn to Administrator Simone to work through some of those funding options for us.
Okay, Administrator, go ahead.
Good morning, Mr. Chairman and members of the committee. Just wanted to give you some high-level points on the administrative grant that we are able to receive from Department of Labor to stand up the STC program. Wyoming has been allotted $177,000 to implement the STC program. Of that, a third, which equals $59,012, is for implementation of the program. And then 2/3, which is $118,025, is for promotion and enrollment of employers. And we have until December 31st of 2023 to apply for that grant. The implementation money that I spoke about would need to go towards our vendor for a contract to do that coding of our system and programming it. It could also go towards staff time for testing that program and putting it into production. And then the promotion and enrollment program I mentioned is utilized on the UI tax side to get the initial employer applications reviewed and approved and moving forward. We believe the entire grant would probably get us through the biennium, and then we would need to look at additional funding for that. A couple things that are important to note is that these administrative funds can be used to stand up the program, but not for long-term staffing of the program. And then to take full advantage of this grant, we would need to make sure our STC program is up and running for a minimum of 5 years.
So go ahead, Representative Gray.
Thank you, Mr. Chairman. Ms. Simony, I mean, this is where, I do get a little concerned. I mean, I just, I don't understand. Obviously, the current legislature can't bind future legislatures, but, this is where I get concerned on this bill is I just don't understand why you can't fold this into your current duties. I mean, in theory, right, that I guess it could increase caseload, but I just am not understanding that. And so anyway, I ask you, why can't you fold this into current duties? Because I mean, in theory, right, it takes away from your other claims. It probably increases on the margin, but you don't think you're going to be able to do that in the medium term, say like 3-4 years?
You know, we took a look at the job duties and requirements, both on the UI tax side and on the benefit side. And I know Director Cooley has some points to make on this as well. But the influx we're seeing with the states across the nation, it seems like we're going to get a lot of employers that participate in this program. And so that's kind of the high point, but I'll turn it over to Director Cooley to speak more to that.
Yep. Go ahead, Director.
Mr. Chairman, Representative Gray, you make a good point. And what we did, you know, if you'll recall when we first, I'll just go ahead and start speaking to that issue of the position, if that's appropriate. If you recall when we first started talking about this in the interim, we were of the belief that we could repurpose a position on the tax side of this to kind of head up this process to get it moving forward with applications, messaging to business, working with business to let them know the pros and cons of the program, and just getting them on board with it, because we're learning from other states that is critical in helping employers recognize that and getting them signed up. So what we looked at is repurposing a position on the tax side, and we found one that was an empty position, I believe just came empty, and I think that's what we're going to do on that side. When you look at the benefits side, that's a little tougher, because that's the area where right now we're still at I believe 500% increase in claims. It was all the way at 3,000% increase in claims. We've got staff there that at one point we were up to 50 temp employees to help. We're now down in that benefits section to 36 staff, temporary staff to help. And the only reason we're able to use temporary staff right now is because the Department of Labor relaxed their requirement, their mandate that we have merit staff in those positions. The reason they want merit staff in those positions is you've got people that have to be vetted to go into those positions and heavily trained, because they're handling incredibly confidential information, and they've got to be answerable to you and to your constituents in the handling of those claims. So what has happened during this pandemic is the Department of Labor actually relaxed that merit requirement up through the end of December. Then we saw another relaxation, and that was extended to mid-March. We don't have any idea of knowing if they're going to, if the new administration is going to extend that beyond that. So in order to have someone there helping to get this program stood up so that it's something that you're not getting calls from constituents saying, well, this looks like a great program, but guess what? We can't get through to even get anything approved, because we've got, you know, we're looking at the potential of over 500 applications coming in initially. So we're going to need an FTE in this. We can't have an AWAC, because at some point that merit staff mandate is going to come back in place. So what we did was we reached out to the Department of Labor, asking them, because we just had a Department of Labor audit, believe it or not, in the middle of a pandemic, a 3 to 4 week audit. And what they told us was, if you are interested in additional positions, let us know. We'll see what we can do for you. So we reached out to them knowing that this was a topic of interest to the legislature. And we just received news this morning from them that we can absolutely do that. We will have to, in order to make it work, we'll have to we'll fill it right now and use other funds, like a fund, our employment support funds to fill that position and pay for that individual. But then the federal government will come in through DOL and backfill those fundings to pay for that position. So, we had to get the fiscal note to you right away. We knew we needed an FTE because going forward, we've got to have this program in place for 5 years. So we knew we were going to need funding. So we needed to put in general funds in there to show you that we're going to need funds for that. But we're going to be able to get federal funds to fill this, to pay for this position. So I think that's good news. It's something that, again, the Department of Labor has asked us about, actively recognizing that it's something we're likely to need. So I think that that's good news in moving forward with this position, or I hope so.
Okay, I'm gonna just real quick with the LSO staff, and I'm kind of looking at the attendees in our calendar. I have absolutely no intention of going past noon today because we have members that are serving on a corporations committee. And being realistic about our calendar, I do not see any way that we're going to hear House Bill 11 today. So I'm going to go ahead and pull that off of the agenda. And some of those that may be watching to see that that bill be worked. We were ambitious taking up all of these, but I just want to be respectful of everyone's time. Okay, Director Cooley, then getting back to this. So section 4 of the bill in committee, if you go to page 20, we worked this through the interim. We understood, Director, that there would be a cost and a burden associated with setting this up. And we have very specific language about creating one AWAC position, but that would not carry through, and that there was no intent for that to carry through into the next biennium. So that's what we have in the statute now. And what I'm understanding is that that's not going to work.
Mr. Chairman, that's accurate. We're going to need the level of work that we in our research has indicated, the level of work in a program like this, we're going to need an FTE that continues through. Again, we've repurposed a position on the other side of this equation to do that, just like you indicated, Representative Gray. But on this claim side, where we're still at 500% increase in claims, we're going to need some help over there.
Okay, I got Representative Western, then Representative Gray.
Thank you, Mr. Chairman. Director Cooley, so you said there's been a 500% increase, but I guess would you maybe translate that into the number of man hours needed to process all that, or personnel? Because it sounds like more than one FTE would be required to handle that kind of workload on the benefit side. Or have you guys kind of been able to quantify that in terms of hours or personnel, or what that might cost in terms of salary for those employees? Thank you, Mr. Chairman.
Good, Director.
Mr. Chairman, Representative Western, excellent question. I think I haven't quantified it like that, but I do know we've paid out considerable amount of overtime pay to our claims side to try, we've got extended hours trying to get those claims paid for this 500%. Could we use another person? Boy, I hesitated to ask for that, and we're very hopeful we can do it with one person on each side of this equation to make it happen. We will be happy to go back and try to quantify that for you. Kristen, is that something, any information you might have available on any of those numbers we've got 36 existing temp staff in UI, and then we've got, the overtime hours. Any way we can quantify that for Representative Western?
I don't know as far as the workload for the new position. I wouldn't necessarily know. I can't quantify that. I don't know exactly what that person would be doing. But we can certainly try to get some numbers together to help answer that question.
So I think, Director, as this moves forward, I guess if it moves forward, so it's up for the committee's decision. We're going to have to modify section 4, and I guess your request is for this to work is that we authorize one FTE and put a period there, and then let you work with JAC on how that gets managed in future budgets with that to simplify this process. But I think we'll probably still end up having a little bit more discussion, because I too understand the burden and the pressure you're under right now. But as we move forward, and this program is utilized 3 years from now, because we have a downturn in some part of our sector in Wyoming, is that FTE being fully utilized, and is it appropriate? And I guess I look at our appropriations committee to hold your feet to the fire on that. So, okay. Representative Gray, you had a question. Go ahead.
Yeah, thank you, Mr. Chairman. Not trying to belabor this, but want to make sure I know what I'm voting for when the amendment comes on section 4. So, Director Cooley, so this one FTE, you've received sort of verbal, acclamation from Department of Labor that will be backfilled by the federal government, and how long will that go for? I mean, is that indefinitely, as long as the programs? This is outside of the $200,000 grant or $170,000 grant, correct? And how long does that? Are they saying they're going to backfill that one FTE indefinitely, or is it 5 years? Or just want to make.
Yeah, good question. Director Cooley, go ahead.
Chairman Greer, it's Representative Gray, it's my understanding that moves forward with it. There's no set timeline. Is that correct, Ms. Burkhart?
Yeah, Mr. Chairman, Representative Gray, we have this complicated formula with UI. So once we get that position added into that formula for our funding, it would become permanent until such time we didn't need the position anymore, or we adjusted the funding. And so it's called our RJM, our resource justification model, that we update every year, and we report on a monthly and quarterly basis. And so if we have adjustments, we add that to our reporting every month, and then they do above base funding to help us pay for additional costs that have been incurred.
Okay.
I hope that answers your question.
Okay, well, committee, we've got, I think we need to tackle that particular issue, because that's something we're going to be dealing with this bill, whether it's approved or so. Okay, any further questions on that particular point? We can revisit later too if they come back up. But okay, so Director, why don't can you have someone or help us kind of take us through the bill? We can just kind of hit the highlights of it and sort of a little bit of the process.
Chairman Greer, I'd be happy to do that. I've never done that before, so I'm glad I went through and highlighted some points that I thought were of particular note for the committee. So I'll go ahead and do it, and I hope I hit the points that are of relevance to you.
This committee will let you know if you don't.
Please do. Starting on page 2 then, and I hope I've got the same draft you do, but starting on page 2, affected units, I think the important thing, these are the definitions. The important thing to recognize there is when you develop a plan, it has to include at least 2 employees or more to have an approved plan. The director means me or my designee, and this will all be happening through our CASPER unemployment office experts. Health and retirement benefits, I think this is a critical part of this bill. When you do have an approved plan, those employees whose hours are reduced can maintain, or the employer is required to maintain those health and retirement benefits, which I think is such a critical thing for the employees. Short-term compensation plan, that's really the plan, the discussion we've just been talking about. And it is, as it indicates here in Romanet 5, it is to avert layoffs, complete layoffs. So as you indicated, Chairman Greer, in your initial comments, we are hopeful that the ending result of this plan will be to reduce the costs pulled out of the unemployment trust fund. We tried to get some definitive data from the Department of Labor on that point, and we're not able to get it. But based on the success of this program, I mean, I would have to believe that that is part of the benefit to the state, is that reduction in money coming out of that trust fund. Unemployment compensation, again, that's the general compensation that is paid for unemployment claimants. Moving to the next page, I'm at page 4, I believe, 273802 participation. This talks about how the employer participates. They are required to sign the written short-term compensation plan. But of critical note, they have to be, in order to do this, they have to be in good standing with the department in order to take part in this program. Moving to page 5, this describes what needs to be in the plan. You have to specifically identify, and this is what this FTE position will be doing. They will be making sure that the affected unit and the employees are specifically identified in that plan. So there's not kind of a shifting in and out of employees. Those employees, as it notes in Romanat 2 here, will be identified by name, social security number, and any other information to help us keep track of them and keep track of their hours and what they're doing. And then also, the Romanat 3 talks about notification to the employees. There has to be clear notification to employees about the plan and what the plan entails and what their requirements will be. Page 6 under Romanat 4, this talks in terms of the usual weekly hours of work for the affected unit. And of note here is the plan will only be approved if the percentage of the employee's hours will be reduced is not less than 10, no more than 60%. So that's like Ms. Funk indicated, some states are juggling around with those percentages a little bit, but we thought that provided us with the most flexibility to work with employers with these plans. Romanat 5, certify that the employer provides health and retirement benefits, and that the benefits will continue to be provided under the same terms and conditions as through the usual weekly hours of work of such employees. So I read that to mean, and I believe it means, that you will provide the same health, or employers will provide the same health and retirement benefits as if the employee were full-time employed as they had been prior to the plan. Okay. Moving on to page 7 under capital A. This one I had to read a couple of times, but I think what it means is if the plans are reduced, the hours are reduced under the benefit plan, they shall be credited for purposes of participation, vesting, and accrual of benefits as though the usual weekly hours of work had not been reduced. So for any of their participation in their retirement or health plan, it will be, again, just like they were actually there full-time with the employer. They have to be credited for that because theoretically, the program requires that they're in the same circumstance. Now, that doesn't mean that the money that they will receive through the employer with the hours they're paid and through the unemployment insurance, their income's not going to be the same. It will be a little bit reduced, but they will get the benefits in those plans just like they were full-time employed. And then the last sentence there, I had to make a note to myself. The dollar amount of employer contributions to a defined plan that are based on a percentage of compensation may be less due to the reduction in the employee's compensation. So they can have a percentage less contribution to those plans due to reduced compensation. That one was a little difficult for me I had to go through that one a couple times.
I'll tell you, Director, both of those make sense to me because you have certain employers where your health insurance will tip over or will become eligible after a certain amount of hours worked under federal law, quite frankly, or by the plan itself. And then the other, when you look at retirement benefits and some health insurance, contribution benefits are based upon a percentage rather than a fixed sum. So to me, those make sense.
Great. Okay. Thank you, Mr. Chairman. Subsection B then also allows, though, a reduction in those benefits equally, if those benefits are reduced equally to employees who are not participating in the program going forward. Page 8, another certification that the employer must make, that the aggregate reduction in hours is in lieu of layoffs. Romanet 7 certifies the employer agrees to furnish reports. And this is a critical part of this. We're going to be getting a number of reports from employers. There's going to be an obligation from employers to report to the division, and we'll have to be following those fairly closely to ensure that there is full compliance. It's going to be a little tricky, I think, at least getting it off the ground and recognizing where some of the loopholes might be in some of these requirements. And then Romanet 8 just really talks about it has to be consistent with other federal and state laws. Moving to page 9, this is where the employer has to certify that the plan expires not later than the end of the 12th calendar month. One thing I want to point out here, and I looked through this for this purpose, even if you have a plan that lasts for 12 months, nothing in this would prevent you as an employer from then initiating a new plan and going forward with another 12 months. So if we should have some significant span of time where this is a benefit to employers, I think that could be a valuable point for employers.
Director, I appreciate, can I get you, just go a little bit quicker and then maybe get an idea. And I would like to get to one more bill today, if possible. So, thank you. Yeah.
Absolutely. All right, 273803, approval of the plan. We have 30 days to approve the plan and get a decision so that employers can really take action pretty quickly with when they get that approval and it moves forward. On page 10, 273804, effective date. The effective date is essentially when that document is signed, and then it's 12 days from that date that they have moving forward. All right. And again, on the top of page 11, employer may submit a new application to participate after the expiration or termination of previous plan. So it can just keep going. If next one, 273805, if they want to modify, they just need to get that proposed modification within 20 days, and we have to approve or deny that in writing within 20 days. So again, it keeps that process going so employers can act and react quickly to the changing circumstances in the state. But that modification on page 12, that modification cannot extend past that expiration date of the original plan. But again, it can be renewed at the end of that. 273806 at the bottom of 12 then talks about revocation. Our agency can come in and revoke that for good cause, which I think in rules is where we would probably indicate what good cause may or may not be. I know that that's a term familiar to many of you. It's in a lot of rules and a lot of statutes. And then any revocation then is subject to review under the Administrative Procedures Act. We then go into 273807, bottom of page 13, and then 14, that talks about eligibility then for employees. I think the biggest point there to make is that the employee has to be eligible for unemployment benefits. They can't be, there's a minimum base rate, and Chris can speak more to that, but they have to initially themselves be eligible. And I think that's a critical point to all of this. Moving to the next page, page 15, I want to point out too, that an employee has to be eligible to, at a minute's notice, come back into work for that employer. So they have to be ready and available. That's critical. But also at the top of page 15, it talks about participating in training and enhanced job skills. That's all part of this. And that's really where we want to work with our workforce centers and make sure that that opportunity is available to them. So, they're sitting around, but they can be upskilling what they can do for that employer. Page 16 just talks about the benefits, benefits to the employer and what they can expect. I think that at the top, at 17, it's critical to point out that the paid benefits for this plan for more than 52 weeks under a short-term compensation plan, they cannot be paid for more than 52 weeks under a short-term compensation plan. And I think the rest of this just goes through, I believe, with a few, I didn't highlight anything in here that I thought was of particular import for employees. It's a lot of this is just the requirements for employees. And then on the last page here, before we get into some of the other sections, I wanted to make sure at page 20, you noted at 273809, the charging to the employer's experience rating account is in the same manner that it's charged under the Unemployment Act. But again, that charging would be lessened because of the amounts being paid out.
I think the handout we received helps us with that.
Yeah.
It's better than the bill itself. Yeah.
Okay. And I think that's the bill in a real quick nutshell.
Okay. No, I appreciate that. Attending, if he's riveted about that, if someone could let him know that we're not going to get to the tax exemption bill, which I would have to guess is why he's watching. So he may be watching but not listening. So okay. All right. Well, so committee, any questions for Director Cooley on the walkthrough on the bill? Okay. Questions we got? All right. Is there anybody that's in this attendee list that is here to testify on the bill? Not seeing any hands going up. Okay, well, I'm gonna close public comment, but Director, if you and your staff would hang tight in case we do come across some questions, I would appreciate that.
Certainly.
So committee, those of us that were through the interim went through this in great detail, I think twice. We've come through this relatively quickly, but I think the concept and the idea is out there for our new members. Okay, so with that, what's the committee's pleasure?
Move the bill.
It's been moved by Burkhart, seconded by, I'll go with Representative Sherwood. Okay. With that, any general comments or questions on this? I think we've got some work to do. Possibly we got some work to do on section 4. Committee may want to just leave it the way it is, Director, and let you work with JAC down the road. So, okay. All right. Well, with that, I'm going to go relatively quickly on this. Then page 1, page 2, page 3, page 4, 5, 6, page 7, page 8, page 9, 10, page 11, page 12, 13, 14, see 15, 16, 17, 18, so 19, page 20. Okay, so page 21. Representative Gray.
Thank you, Mr. Chairman. I guess I have a conceptual amendment. You know, the amendment would be that we replace this one AWAC employee with one FTE, but to have some language that this is the understanding this is going to be backfilled by federal funds. I would like to have that language there. I do think we should try to work this and not just bring it to the floor without it probably be re-referred to appropriations, I imagine. But that's the conceptual amendment, and I'll cede to Representative Burkhart and Chairman Greer and anyone else because you guys have been on appropriations. So
we'll try that. Is there a second for that conceptual amendment? Then we'll shape it up just a little bit.
Second.
Representative Burkhart seconded. Representative Burkhart, you served on PROPS longer than I did. Do you want to try to? I've got an idea on how to do this, but.
Mr. Chairman, yeah, I've served on appropriations and you know their position on more people. However, from a conceptual standpoint, if I might, for Representative Gray, I do have some suggested wording changes. And that they would be, and I'm looking on page 21, line 5, after the number 1, strike at will contract and insert full-time equivalent position or full-time employee position. Then down on line 9, strike and shall end on June 30th, 2022. And then insert the position shall be funded from available federal funds for this program.
Okay. Then.
And then, Mr. Chairman, line 14, strike, it is the intent of the legislature that, and then start that sentence with the position authorized in this section, strike not, and insert may, be included in the department standard budget for the immediately succeeding fiscal biennium.
Representative Burkhart, can we just drop that lines 14 through 17 and be cleaner?
Mr. Chairman, it would be cleaner, yes.
Representative Gray, are you following along, agreeing with this cleanup?
yeah, thank you, Mr. Chairman. That's definitely friendly. And if you want, we can make that the motion.
Okay. Just keep working on this just a touch because so we do not need, so committee, I'm sorry here, this is a little informal, but this bill was initially teed up for maybe something in a special session. And so we really don't need to work through the B11 process for this, what was the at will position, because this will be, if this comes through, this will be included in the supplemental budget. So I think we could remove that language and make this a touch cleaner. Do you agree?
Mr. Chairman, I do. So that would be on line 9. Start with the department and delete the rest of that sentence, correct?
Correct. Yeah.
Yeah, I think that, Mr. Chairman, I think that cleans this up considerably. If it's okay with the sponsor of the amendment.
Yeah.
I feel kind of funny working his amendment for him.
Yeah. No, that's all right. He asked you to, so it's fine. Representative Gray, how are you good with that? And I'll kind of recap here, 30,000 feet on the amendment, and then we'll get a chance to look at it, make sure it's clean.
Thank you, Mr. Chairman. That's friendly. Thank you. And thanks for the help.
Okay, so committee, just a second, Representative Duncan, so committee, what we have here is the Department of Workforce Services is authorized one position, and that the position shall be funded by available federal funds. And basically we've cleaned out the B11 language, and then we also have cleaned out this intent language. Is that correct? Does that sound right, Representative Gray and Burkhart?
Yes, Mr. Chairman.
Okay, Representative Duncan, does that help?
Just to clarify, are we striking out the remainder of the line 9 through 13?
Yes.
Okay. I'm taking notes, that's why.
Okay.
Thank you.
All right, so conceptually here, and I think we're better than conceptually. I think we have a solid amendment. Is we're going to go ahead and put in here, clean it, I think is Representative Gray, our responsibility to clean it up, and then this can be debated further as it works through, because this will be reassigned to appropriations. Is a one FTE, that FTE should be funded by federal funds that may be available, and the rest of that's cleaned up. Okay, I'm seeing a lot of heads nod, so I'm going to go ahead. Okay, any more discussion on that? Seeing none. Okay, we're voting on the amendment. All those in favor, raise your hand. Okay, I see that as a unanimous vote. Okay, that amendment's adopted. Okay, moving on then, section 5. And this is one, Bill, just to point out that it'll be effective immediately. So this could be a quick hitting bill, which I think is appropriate. I don't normally think that. So, okay. All right, committee, any further discussion? All right, sensing you're ready. Question being called. Thank you, Representative. We will then have a roll call vote on House Bill 9, short-time compensation.
Yes, Mr. Chairman. Representative Baer.
Aye.
Representative Burkhart.
Aye.
Representative Duncan.
Aye.
Representative Ayer.
Aye.
Representative Gray.
Aye.
Representative Heiner.
Aye.
Representative Sherwood.
Aye.
Representative Western.
Aye.
And Chairman Greer.
Aye.
Mr. Chairman, the bill passes with amendments.
Okay, well, thank you. I'll look for volunteers for someone to floor manage that. Just let me know. Representative Ayer will be presenting the trust company amendments that we worked earlier. Thank you, Representative Ayer. Appreciate that. Okay. All right. So this next bill up for consideration, and we should be able to get through this. We may go a few minutes over, but it's House Bill 10, the COVID Large Business Relief Program. And again, Director Cooley and your crew, thank you. We appreciate it. So this, go ahead, let me get this pulled up. Representative Burkhart, would you go ahead and walk us through that bill? And then I've got some attendees still in there. Anyone who wishes to come in on this subject matter, please raise your hand. We'll let you and get you started on the screen. So Jody Levin, and we can let Jody in. Okay. All right. So go ahead, Representative Burkhart.
Thank you, Mr. Chairman. Let me start by saying this bill was prepared initially with consideration that there would be a special session. That special session never occurred. So the dates in the bill are in effect out of date, and some of the references are out of date. I do have an amendment to correct that, and I'll bring it at the appropriate time. So as we go through this, remember that the dates and some of that information will change. During the past year, there were relief bills, measures for many companies. However, some of our companies in Wyoming were not able to participate in those, mainly due to the fact that they're larger companies. But those larger companies have kept a lot of our communities going. They've kept their people employed out of their own pocket, in effect, while some of them have lost up to 40% of their production and their income. Those employees who kept working were able to get food takeout from restaurants, keep local businesses going, make purchases, and really bolstered our communities in which they're located. So the bill recognizes that and offers some relief in a small amount to those companies that meet the criteria. And the criteria are fairly simple. So with that, I'll walk through the bill. I will not read it to you. So there's a definition for eligible businesses established before the any closure orders. It must be a publicly or privately owned business. And the two big ones paid not less than $1 million in 2019 taxes on real property, or had a $10 million payroll in 2019 or more. That alone really restricts the number of companies. And $10 million, the average pay in Wyoming, that would be about 200 employees. That has to have principal operations located in Wyoming, and principal was a word decided on during the interim as a way to keep that money in the state, recognizing that there are many companies that also have some of their operations out of Wyoming, but their principal ones are here. Have to employ at least 100 employees. Must have been here prior to any closure orders. Wyoming Business Council is given the authority to and requirement to establish and administer the program. Defines, and I'm on page 4, how an eligible business may apply. That the Business Council may contract with financial institutions for help, and that at the bottom, an applicant has to have an expenditure plan. They can't just go in and say, give me money. They have to have a plan on what they will use it for. And page 5 is very specific, and this was worked extensively during the interim, what that money may be used for payroll costs for Wyoming employees, for business supplies, business equipment necessary to carry on operations or to modify operations, other business expenses that may be due to COVID, and any other expenditure due to interruption. These businesses didn't close, but their business operations were significantly interrupted. The applicant has to demonstrate that they incurred actual losses in April, May, and June of 2020 of not less than 25% compared to the corresponding period in 2019. And that the council shall calculate those losses in comparison to the previous year. The stipends awarded are limited to $1.5 million. And on page 7, further down, the companies receiving them have to continue to maintain principal operations in the state of Wyoming for 3 years, provide a report to the council, and that repay funds if they don't do any of those. Page 8, Romanet 10 and 11. These are the sections to prohibit double dipping, which was a major point of discussion in the last committee meeting last year. And page 9 at the bottom, section 2, the reappropriation of the money out of the funds from the special session is limited to $10 million. And then the rest of page 10 talks about the funds and the CARES Act and those session laws, and would be effective immediately. And that's the bill in a nutshell.
Okay. So Representative Burkhart, you do have a proposed amendment that was sent out to clean up the dates to make this carry forward. I also, not that this is necessary, required here, but the business that I run does not qualify for this. We just fall under these thresholds. And I'm also going to state that my business never did apply for any of the state economic relief funds. So just want to make that clear. As I'm doing my job with the purest of heart here and trying to help out other businesses, and this has absolutely no impact on the business that employs me. So I just want to make that clear. Okay. Any questions for Representative Burkhart? Yeah, go ahead, Representative Gray.
Thank you, Mr. Chairman. Representative Burkhart, appreciate your work and the committee's work on this. When I was reviewing this, my one question is, was there any discussion on creating some sort of objective criterion for the executive branch to make the decision? I mean, I guess it's like eight awardees under this, probably if they approach the cap. I think, I'm not sure how many are eligible. I think it was around 100 would be eligible. And to me, someone's going to have to make that decision. I imagine some are going to apply, and somebody's going to have to make the decision. Maybe it's just first come, first serve, and that's maybe WBC talks about that. But, I would prefer for the legislative branch to have some sort of objective criterion that at least the executive branch has to carry out. But was there any discussion on that? Do you have any feeling on that idea? Thank you.
Mr. Chairman, Representative Gray, the criteria was laid out, the first being that they have to pay $1 million or more in assessed property value. That's a fairly large company in Wyoming. They also have to have a $10 million payroll in 2019, again, fairly substantial, and that they have to show actual losses exceeding 25% or more in two comparative periods in 2020 and 2019. And then the council, by rule and regs, shall establish other criteria for them and how they would provide that money. And then what the money goes for, specifically payroll costs, business supplies, and those. And I hope I've answered your question on criteria. We got fairly specific during the interim on what would or would not qualify under this program. And then I guess I would ask, does that answer the question, or am I misunderstanding it?
Go ahead, Representative Gray.
Thank you, Mr. Chairman. Representative Burkhart, not really. I consider those more qualifications, and I think there's going to be more than 8 businesses that apply. So how are they going to decide? And I imagine it's going to be something along the lines of first come, first serve under the current bill, or they're just going to pick who they feel is most qualified. And I, in my opinion, we should do more, but maybe I could ask WBC, but that is just my opinion. Thank you.
Mr. Chairman?
Yeah, go ahead.
Thank you. Representative Gray, one thing we did, this is patterned very closely after the other bills, the small company bills, the medium company bills. And in that, the Business Council was allowed to establish that criteria. Again, trying not to be too specific, open it up to as many companies as possible. And I would imagine the way they did it with those others, I think some of those were on a first come, first serve basis. That's why additional money was added later, was to catch up those companies who didn't apply as quick as others. And I guess that may not answer the question exactly, but that's what the legislature had allowed the Business Council to do in those previous bills.
Okay, so I had Representative Baer, then Heiner, but I think Representative Burkhart, and I'm just trying to facilitate the discussion because it's a good one. It's, do they have to show that their loss in income or revenue is directly caused by the pandemic and I think that maybe, and I know that's something that we kicked around before with that, but not just you lost revenue quarter over quarter comparing the 2 years, but rather that you can demonstrate, so for example, let's take an oil refinery, right? There's no demand for their product because nobody was driving anywhere because of all the closures. And so it's implied in there. And I guess what thought have you given maybe to making that more specific?
Mr. Chairman, was that a question for me?
It most certainly was, Representative Burkhart.
Thank you, Mr. Chairman. To make it more specific, again, it was to show a 25% loss, and they have to demonstrate it by producing the records to show that. That was where we left that one.
Yeah. Okay. Representative Baer, you had a question, then Heiner, then Sherwood.
Thank you, Mr. Chairman. I should remember this because I know we discussed it, but could you refresh my memory, Representative Burkhart, regarding the number of businesses in Wyoming that may qualify?
Mr. Chairman, Thank you. Representative Ayer, right now in Wyoming, the latest information I have is there are just under 400 businesses with more than 100 employees. There are 19,000 who have less than 100 employees. Out of those approximately 400, and it's a little less than that, estimate is that maybe 10%, 40 of them might qualify. For example, a hotel might have several hundred employees, but may not reach the threshold on either taxes or payroll. And that large companies are the largest employer in the state is a large retailer, but their principal operations are not in Wyoming, so they wouldn't qualify. So that's, I would estimate 40 at the most, probably closer to 20 to 30 would qualify.
Representative Heiner?
Thank you, Chairman. Just a point of clarification, where will these relief funds come from? It's my understanding we've committed most of the CARES Act funding. Is this anticipation of a CARES Act number 2, or are the funds coming from some other resource? Thank you.
Mr. Chairman, Representative Heiner, the funds are coming out of the CARES Act money if it is extended, or out of potentially other federal programs. There's no state money involved here. If you look at this, this is non-codified law. This will go into session law, so it's not in statute. There's a slight difference there, but it would come from any potential, and the amendment I have indicates that it would come from potential other federal relief programs.
Sir, I'm going to piggyback on that answer just a little bit. Representative Heiner, there's a certain amount of disagreement on what has actually been expended, used, obligated, committed, or otherwise between LSOs, the Appropriations Committee, and the folks that do the analysis there, and the governor's office. And I guess my feeling is if we feel this bill is worthwhile as a legislature, it is our job to direct where funds should go, and I have no problems grabbing that and saying where it goes. It's about as politically correct as I can be on that comment. So, Representative Sherwood.
Thank you, Mr. Chairman. This is just more of an open-ended question on page 6, lines 8 through 9. It defines the time period of the incurred actual losses of sales, revenue, or production, currently stating April, May, and June of 2020. What are the pros and cons to extending that time frame or the definition of when a business has to show losses?
Go ahead, Representative.
Mr. Chairman, the 3-month period was what the committee came down on from the interim. Felt that was acceptable. That was at the height of the closures, stay-at-home orders, those sorts of things, and was probably the toughest time. Then picked up. The idea being is to cover what was known at the time. Again, it could be anything. It limit the amount of paperwork done by the businesses and by the business council. And that was the choice of those dates. And again, it was in anticipation of a potential special session. So I think those dates are still accurate.
Yeah, Representative Burkhart was breaking up a little bit. Some of the reason why those were limited, Representative Sherwood, is just as that is we thought this may come before the legislature in a special session, and we were trying to find a cutoff date so it was easier to find a measurement. Okay, committee, I'm going to keep us moving. Any further questions right now of Representative Burkhart? Okay, let's go ahead, and Ms. Levan is the only person I see for public comment. She is on our screen. If she could turn on her camera. Okay, please introduce yourself, who you represent.
Good morning, Mr. Chairman, members of the committee. My name is Jody Levin. I am here today on behalf of the Trona industry and also the Wyoming Mining Association. Mr. Detai had a conflict this morning, so he asked that I provide some brief comments just to relay that the Wyoming Mining Association stands in support of the bill. The 4 Trona companies located in Sweetwater County would meet the eligibility requirements under this bill. We appreciate the committee's work on this over the interim. The Trona industry collectively between the companies employ about 2,300 employees, and they saw a loss of production due to demand. It hit a low in June of a reduction of 41% since December of 2019. And much of that was driven by closures in other states where they literally just saw their markets dry up. They incurred significant expenses to try to provide health and safety measures for the workforce to try to keep employees working. Some of the companies unfortunately had to look at some layoffs and furloughs. I'm happy to say that they have been able to bring some employees back. Some of the companies never laid off a single employee, and that caused them to have to look at unique work shifts to try to deal with COVID, a lot of storage expenses on soda ash as they tried to continue mining and just prepare for when markets reopen. So things are looking up. They're nowhere near where we had all projected that they would be, but things are improving. This bill would, if they chose to apply for it, it would help mitigate some of the costs that they have seen, which have been, as I indicated, pretty significant. Just on health and safety measures, I would say on average, the companies were spending about an additional $300,000 a month to provide additional sanitation, security, and again, trying to look at unique work schedules to try to address social distancing. That is a real challenge in a mine. So again, Mr. Chairman, I know time is short. On behalf of the Trona industry and the Wyoming Mining Association, we thank the committee and stand in support of the bill.
Well, thank you. Any questions for Ms. Levin, committee? Questions? Okay, Representative Gray? And folks, we'll go 10 minutes over here. Our corporations committee members will be patient with me, I know. Go ahead, Representative Gray.
Thank you, Mr. Chairman. Ms. Levin, I was hoping to ask, I do think this is a little different from some of the earlier grant programs, and I know I wasn't on minerals, but, was on the floor on those programs. These are huge awards. And so I think we should try to put a little more specificity on what the objective criterion in deciding who's going to get them if there's more applicants than funds available, which I anticipate there being. And so I was just thinking that the WBC we would require them to create some kind of list of estimated losses and rank those. What do you think about that idea?
Ms. Levin?
Mr. Chairman, Representative Gray, the Trona companies, I think this is a purview of the legislature. If the legislature wants to put additional criteria around eligibility, they'll look at that program, they'll see how they could qualify, what information they need to gather to prove kind of their case. I understand we are talking about limited funds and substantial awards. So I would expect that the legislature and the business council would be pretty thorough in requirements to the companies.
Okay. Representative Bear.
Thank you, Mr. Chairman. I just want to speak in support of Representative Gray's suggestion that we make this, additional criteria based on the larger loss. So if a company made a bigger effort to keep more employees working during this time frame, I think they should be rewarded with a little higher opportunity to obtain these funds. So that's just my opinion.
So Representative Gray and Representative Bear, while we work this, we've got an amendment regarding dates, right? We'll have to work through that, but maybe find the right spot in the bill for a placeholder, and then maybe this committee could kick around some sort of conceptual amendment that we can, do like the last one, maybe work a little bit. Because what I'm hearing is that, if you went the extra mile and kept your employees on at a greater loss and risk to your business, then maybe you ought to be first at the table. Is that what I'm hearing? Yeah, I agree with that concept. Representative Gray.
Mr. Chairman, just was wondering, I was in communication with Mr. Fuller about drafting something. Is the intent to go till 12:30 or just till 12:10? Because if should I continue with that, or should we maybe do it in between the next meeting?
Well, committee, and maybe this is as good a time as any, is that, we were asked to bring 2 bills forward for the virtual session. We've got 3 that we've worked. So if you think about the short-term compensation, I believe, and I guess my prerogative as chairman, we need to get up in that virtual session. I thought the trust company amendments would be a simple one. That'd be a little easier for us to work through in that format. We do have the consumer credit amendments, as we can all tell, will be difficult to manage and get through. So, maybe what we do is just hold this open. And then when we come back in, and I'll see what we're going to do for more committee time, is we're at a point where we've had pretty good discussion on this, is maybe we work on an amendment, bring it in, and do this right with these thoughts rather than hurry through it. And I'm looking for head nods or anything along those lines, if that's a good idea.
Yes.
Okay, so why don't we do this? We're at 12:01. I know we're all here to do work for the people, but I'm a firm believer in staying on agenda or on time. Maybe Chair would go ahead and entertain a motion to go ahead. And I think what we'll want to do is table this and at the discretion, and then I'll just bring this back up after we get a chance to work on it.
Mr. Chairman.
Yeah, Representative Burkhart.
Mr. Chairman, I would motion that we table this until our next meeting and carry it over till then.
Okay. Just a second. All right. All those in favor?
Aye.
Okay. So now, as chairman, and I wish I had like a badge because that'd be cool. I'm going to appoint Representative Bear, Representative Burkhart, and Representative Gray to a subcommittee to hash out this issue for us. So if you guys would do that for us, I'd appreciate it. Okay. Then with that, before we adjourn, Amanda, can you give us just a quick recap of what we voted on, and then help me on, I guess we'll do this through email on a verification of the amendments and signing off on the report to the speaker.
Yes, Mr. Chairman. So what will happen now is we will get the standing committee reports to you along with amendments, and those will be sent to you via email. Going through what we've done today, House Bill 008 passed with amendments. House Bill 006 passed, and House Bill 009 passed with amendments.
Okay. All right. No, that sounds good. And then we tabled 10, and we'll work on that just a little bit more. I think we need a little more time on that if we want to get that kicked out. So Representative Duncan will floor manage the consumer credit amendments bill. I don't know if that'll come up in the virtual session or not. Representative Bear will manage the trust company amendments that will come up. Well, I'll push for it to come up in the virtual session. And then Representative Sherwood, short-term compensation will be yours to floor manage, and lean on other more experienced legislators to help you out with that. And as everybody on this committee knows, I'll be standing in the back of the room ready to step in and help at any point in time. So, okay. All right, I can't wait till we all get in the room and I can read everybody's body language and see who's in the crowd. I look forward to getting back to normal. But for today, good work. I appreciate what the committee did. I appreciated the comments and the input from the new members in particular. And to our older members, your steadfast guidance was very useful. And so with that, we'll go ahead and adjourn.